With alongside Bradsman, this is Yahoo Finance's flagship show, The Morning Brief. Stock futures higher 30 minutes ahead of the opening bell on Wall Street, on pace for a winning week. The Dow looking to extend its 7-day win streak. The S&P 500 closing above 5,200 for the first time in a month.
Wow, here. All right, this move comes on growing optimism that the Fed's next move is a cut and could come in September. We've got a slew of comments from Federal Reserve officials today and all throughout this week. We've been hearing from them. Fed Governor Michelle Bowman speaking right now as we speak. So let's get to it with the three things that you need to know, your roadmap for the trading day. Yahoo Finance's Jared Blickery, Madison Mills, and Anjali Khemlani have more.
The major averages on pace for a winning week, and we're seeing optimism spreading across the pond. Now, in Europe, we have the FTSE, the DAX, and the CAC 40 all hitting fresh record highs as the UK exits recession, posting its fastest GDP growth in 2+ years.
And President Biden expected to announce an update to tariffs on trade with China as soon as next week. That announcement reportedly targeting specific sectors, including electric vehicles, semiconductors, and solar equipment. The update comes after a review of tariffs put in place under former President Trump back in 2018. Now, this would be one of Biden's biggest decisions regarding Washington's economic ties with China.
Meanwhile, shares of Novavax skyrocketing up more than 100% pre-market as the vaccine maker announces a $1.2 billion licensing deal with Sanofi. The agreement allows Sanofi to co-commercialize Novavax's existing COVID vaccine, plus accelerates creation of its combo COVID flu and other vaccines using Novavax's vaccine platform. As part of the deal, Sanofi will take a minority stake in Novavax.
Futures pointing to a higher open on Wall Street. Investors optimistic that comments from Fed officials suggest that the central bank is still on track to cut rates this year, which was echoed by Atlanta Fed President Raphael Bostic in an interview today. Our next guest saying that the consumer can make or break the Fed's next move. For more on this, we want to bring in Kayla Setter, State Street macro multi-asset strategist, is here. Kayla, it's great to have you here. So let's talk about what we're hearing from Fed officials this week. Certainly, it seems like investors, at least traders, still remain hopeful that we are going to get that rate cut here in September. What's been your takeaway from the commentary that we've gotten so far?
Yeah, I think it is likely we could still see a cut this year. However, I think the biggest risk for markets right now is that they're going to bring forward that cut far too soon, because what we've seen is that the consumer is still in aggregate resilient. There are signs that some consumers are feeling pain, and that's actually a good thing. That means that the transmission of policy is working. However, that transmission is really slow, and so I think that's why we've seen a lot of Fed speakers kind of echo this message of patience.
Yeah, we're going to be getting preliminary consumer sentiment reading later on this morning here. Kayla, what are you going to be watching most notably for in the moderation in this consumer mindset, especially as it dovetails through to some of the economic data that's coming next week on CPI?
Yeah, I think the data we get today is important, but the data for next week is even more important. We do still want to see consumer sentiment roll over just a little bit, I'd say. However, I think next week what we're really looking for is really a rollover in inflation and a continuation in a move lower in inflation numbers. And actually, when we look at some of the data that we can see in terms of price stats, which is online goods inflation, we're seeing that some signs of softer data coming in. And that's really important because if you think about the progress so far on inflation, it's really been concentrated in the goods space. And so what that means is to get further improvement, we can't see goods reaccelerate, and we finally need to start to see signs that the consumer is weakening in a way that it impacts the services side of inflation.
Kayla, when you take a look at the recent market action, we have certainly started to see investors maybe get a bit more defensive given some of that uncertainty that we've been talking about here over the last several weeks. What is the movement here that we've seen towards consumer staples and really towards utilities? What do you think that further tells us then about the market leadership that we'll likely see?
I think moving forward from here, we still really prioritize large cap quality growth. We're not tempted by moves to go to small caps or even some slices of, more, I'd say, value. Just because if we think about it, the progress on inflation is likely going to be very slow. And so what that means is we're going to be in an elevated for longer environment, I think, than some folks may anticipate. So we really are seeing the most opportunity in places like tech, in places like communications. And so we see leadership ultimately remaining there, even though I do know the past week or so, we have seen a couple adjustments. We still prioritize the places that look best equipped due to balance sheet strength and things like that to really navigate this interest rate environment for longer.
And with that in mind, even as we're navigating the back half or the waning parts of this earnings season, there's still one key barometer that's left for the markets here, and that's something that started off all of the fanfare around generative AI, and that was NVIDIA. And so as we're kind of waiting for that, and then later on going to be getting even more retail results, how could that set up some of the growth forecasts here for the rest of this year?
Yeah, I think when it comes to tech, generally speaking, one thing that was pretty interesting is that heading into earnings season, we did see institutional investors kind of take a step back from tech just because earnings season seemed to be such a big risk. But now, so far, earnings have been okay. We're starting to see more moves back into tech. And so I think moving forward from here and into the rest of the year, we still really like this space. When it comes to retail, it is a bit nuanced, but I think we still like the spots that are able to cater more towards services. Because when we look at how consumers have adjusted their spending habits since the start of the hiking cycle, they're still spending more on services than they are goods. And so that's kind of relatively how we're thinking of navigating things.
Kayla, I've pulled out the flip-flops. I've started to not wear socks on Fridays at this juncture. I'm trying to figure out if I'm selling in May and going away and I'm getting ready for the summer travel season, where are areas that I should feel comfortable selling out of right now, and where are areas that perhaps I should be buying into, sectors that you're bullish on?
I think I've already talked about tech. I think another place that we still really like is energy, actually, especially because if we think we're going to be in this elevated for longer environment, it's going to be because growth is stronger than expected, or at least growth is maintaining. And so I think energy is one place that could be a little underappreciated, or some people may have questions about if the Fed is going to, if they are concerned about the consumer. But because in aggregate, the consumer is still okay and we still see demand for travel and things like that, I think energy could be a pretty good place to play that.
Absolutely. Kayla, thanks so much for taking the time. Fortunately for our teammates and many of the employees here at Yahoo, it's against the employee policy to wear open-toe shoes here. So ultimately, I'm not wearing the flip-flops. I don't have the socks. Yeah. Well, I got the little footy ones. You got to have those in the arsenal. Kayla Seder, who is the State Street macro multi-asset strategist, thanks so much for taking the time.
Thank you.
Thanks. Well, President Biden is getting set to unveil new China tariffs as early as Tuesday, according to several reports. The announcement will reportedly target specific sectors, including electric vehicles, semiconductors, and solar equipment. Yahoo Finance's Prosy Romanian and Rick Newman, they join us with the details. Rick, let's start with you on this. What's the impetus behind this from the administration?
It's no surprise the Biden administration has basically telegraphed this. And it's to protect the American industry. I mean, it's basically straight up protectionism. This is different from what Donald Trump did when he was president and what he wants to do if he becomes president again. Trump put tariffs on a whole range of Chinese imports. And this is just very targeted. This is meant to basically keep Chinese vehicles out of the United States. It's not going to affect cars that are in the market today. For the most part, there are only a couple of models that are on sale in the United States that are made in China. And those are actually brands we're familiar with. Those are not Western brands. One of those is a Buick product. So it's not like the price of cars is suddenly going to go up because of this tariff. This is meant to keep those products out of the United States. And of course, this is happening as Biden has also signed into law legislation that will provide huge subsidies for semiconductor manufacturing, for other types of green energy technology, including solar panels, and for electric vehicles. So all part of the same broad strategy.
Pras, talk to us a little bit about what specifically this could potentially mean here for EV makers, because when you take a look, at least in the Chinese EV makers business, there's the case made that maybe this isn't going to have a material impact given the fact that they're not too exposed here to the U.S., but stiffer trade barriers, though, for the longer term. What are the implications then for the broader EV space?
Yeah, we're seeing some of these Chinese EV makers listed in the U.S. trading slightly lower here, but for the most part, in the near and now, they sell zero EVs in America. All their sales are in China and potentially Europe. So it's not going to really affect them currently. Potentially down the line, there's always been talk of these EV makers coming stateside here. I don't think it's going to happen anytime soon, especially if we see these targeted tariffs like Rick had mentioned. We have no details yet as to what these could be in terms of percentages. Currently right now, there's almost a near 30% tariff on Chinese-made automobiles. Perhaps Biden extends that to EVs or even all of their Chinese vehicles. And obviously, there's the chip angle too. So not exactly sure what this means for them at this point. For the U.S. automakers, it's a slight boon here, but I think at the same time, the competition is going to be coming whether they like it or not. And the question is when. So I think the tariff, the protectionism aspect of it, a lot of automakers saying that, we have to kind of compete with the Chinese on their own terms. So we'll see if they can actually address the market. But for the time being, all you hear from U.S. automakers is like, we're making hybrids, we're making more gas-powered cars. You guys still like those, right? That's sort of what we're seeing here.
Yeah, and Pras, what kind of backlash could this prompt from the Chinese as well that impacts these U.S. automakers that are trying to also cozy up to consumers in the region?
I think the big impact here, and maybe Rick can speak to this more, is the fact that if we do these tariffs on these Chinese EVs, for instance, will the Chinese retaliate on battery technology, battery parts, components, the all-important materials like lithium and things like that? Are they going to make it harder for us to make our EVs in this country? Because we still get some of that material from China. So I think that might be the problem, is any kind of retaliation on the Chinese.
All right, Pras, Rick, thanks so much for breaking that down for us from both sides here. We really appreciate it. All right, we are just getting started here on the Morning Brief. Novavax shares skyrocketing after inking a vaccine deal with Sanofi. We will break down the details next. And Taiwan's semi showing AI demand is not slowing down, at least anytime soon. Sales jumping 60% in April. We'll give you that breakdown this hour. Plus, Sweetgreen raising its full-year sales forecast. We will bring the conversation with the company's CEO. That's coming up at 9:40 a.m. Eastern Time today. All that and more. You're watching Yahoo Finance.
Let's take a look at some of the top trending tickers on Yahoo Finance this morning. Novavax topping the list here. Shares skyrocketing after announcing a $1.2 billion deal with Sanofi to commercialize a combined COVID-19 and flu shot. Yahoo Finance's Anjali Kemlani has the details for us. Did I get the prono route
It's
right on
Sanofi,
that?
according to the French. I know, I get it wrong every time. I got it wrong earlier,
Friday,
but it's okay. Everyone says it differently. So Sanofi, big pharma coming in to help Novavax out. Novavax inking that deal, $1.2 billion, and that includes co-commercialization of the COVID vaccine. That's the one that's currently on the market, as well as the combo flu and COVID vaccine that they've been working on for quite some time. If you recall, Novavax was initially working on just a flu vaccine before the pandemic. So this is kind of going back to the roots. Meanwhile, there's an additional part of the program, which is going to be an additional $200 million for any other vaccines coming out in the future that have to do with Novavax's platform. That's the adjuvant Matrix M platform that they're known for. They've been licensing out as well. So that's where this whole deal comes in on, looking at the Novavax pipeline. Meanwhile, Sanofi also gets a minority stake, less than 5% stake in the company, and investing $70 million specifically. So that boosts Novavax's valuation, and that's why you're seeing the share skyrocket today, up over 120% already.
Yeah, and talk to us a little bit more about what exactly this means ultimately for Novavax's business here in the long run. And then does this totally erase all of those concerns that we had going back just over a year ago about their ability here to continue?
100%. This literally saved Novavax. They were struggling. They were looking like, they weren't sure whether or not they could stay operational for the long-term future, in part because they entered the vaccine race late. They started off in the initial batch during that Operation Warp Speed program, but they met with some manufacturing delays and then ended up falling behind and only getting approved in mid-2022 after the initial round of vaccines already started. So they were really eyeing the booster market. They've seen a little bit of revenue come in there, but meanwhile have had to slow down, make some cuts, and really realign on their books what they're looking at, cut down on R&D as well. So that's all been impacting the company. Meanwhile, Sanofi, a really strong flu program and profile. The flu vaccines contribute a lot to their overall vaccine portfolio. 2.8 billion of the about 8 billion that they receive annually comes from flu. And so the match that's being made here is that Sanofi's platform is also a recombinant protein vaccine, just like Novavax. So that's why this deal makes so much sense. And just a little point there as well, Sanofi also did the same thing with their COVID vaccine in partnership with GSK, entering the market late and also eyeing that booster market. So they're really on par in terms of sort of what their strategies have been for COVID. So it may be a match made in heaven.
That experience could potentially here pay off. All right, Anj, thanks so much. Shifting to the chip sector, Taiwan Semi shares rising after reporting that sales jumped nearly 60% in April from a year ago. Yahoo Finance's Dan Halley has more on that for us. Dan.
That's right, Shauna. They jumped 59.6% year over year. That's better than any other month so far this year, although it's only May. Still, it's a huge jump. And I think the real reasons for this are clear. That's, the AI craze driving everybody to go out and purchase chips or request chips to be created or built, the likes of NVIDIA, AMD, and whatnot. And then the kind of somewhat return of the smartphone market. There was that huge dip that we had seen. Now we're starting to see that begin to climb back. And that's going to drive sales at TSMC just because so many of those chips are made at TSMC's facility. So we're seeing that and the AI demand kind of come together to help push the company's sales much higher in the last month. It'll all depend where we start to see the smartphone market really go, though. Is it going to be a huge jump in demand? Is it going to be a general improvement, or is it going to be a slog to get back to where it was? So I think that's going to be one of the main things to watch. But on the flip side, the AI side of things is going to continue to drive a lot of demand and sales, especially for more expensive, more advanced chips.
And for TSMC, I mean, this is a company that's continued to see, 50% margins on their foundry business, and they're waiting for, they would have it as no competition entering the market, but there is more competition that's going to be entering this market. Intel, it's going to take them some time to scale. I think 2030 is what we're hearing, that they would even get to 40% margins on their foundry business by. So how much of the lead time is TSMC still believing is baked into this business, and for investors to still continue to expect results like this?
Yeah, I mean, there's two things. There's the foundry business, and there's the ability to produce very high-end chips. And so Intel is trying to do the very high-end chips. They're just about there with regards to that. As far as their foundry business goes, though, yeah, you're right. It's going to take quite a while for them to get up to snuff. They're still going to be producing largely Intel chips for the foreseeable future until they start to get more customers. Now, they do say that they have customers lined up. One of the big ones they have is Microsoft. They're going to be building their own chip. Intel does have a roadmap that is very impressive. It's just about now kind of executing on that. And so for TSMC, yes, it means that there's competition, but kind of as you were alluding to, it's pretty far off at this point. And they still are the world's largest manufacturer of processors.
Yeah, great context there. Yahoo Finance's own Dan Halley. Dan, great to see you here this morning. Thanks so much. Well, SoundHound shares, they are surging after boosting their full-year revenue outlook. The company's CEO saying voice AI is quickly becoming a must-have tool for customer service. Shares of SoundHound, they're up over 120% so far this year. And here this morning, you're seeing them moving higher on the back of this news. As we were continuing to track this going into the start of today's trading, they're saying that this first quarter sets the tone for another year of strong growth for SoundHound here. And then additionally, one of the other things that they note, 73% Q1 revenue growth, the first quarter closing with about $226 million in cash. Going to be an interesting kind of calculus of how they start to deploy some of that cash over time as well.
Yeah, Brad, you're exactly right. And when you take a look at the analyst reaction initially to this report, you can see some of the enthusiasm playing out in these quick comments. From Wedbush, they're saying that this report is, quote, a major step in the right direction for the company as they do continue to build towards profitable growth with stable revenue pillars. Again, this is according to Wedbush. They have an outperform rating on the stock, a price target of $9 a share. And Cantor Fitzgerald was also very upbeat following these results, saying that some of the partnerships that were announced when it comes to the car space, when it comes to the restaurant space, that is going to be beneficial here to future growth. So we certainly have talked a lot about this name here over the last several months, been trading. Questions about how much certainly has been trading in tandem here with some of the fundamentals of the business, but at least from these results here and from the quick commentary that we're getting here from analysts, there does seem to be at least a real reason to be optimistic about this name in the longer term.
I'm just smirking, laughing here a little bit because this has got to be one of the first earnings reports where I've seen Church's Chicken shouted out. You talked about the restaurant business, and you put the very classy term on it. But yeah, Church's Chicken getting a shout out in the SoundHound AI earnings report here. One of the big deals. Too. Yeah, quick service restaurants. It sounds like that's going to be one of the areas that SoundHound can really play into as of right now. So. Good for you, Church's Chicken.
And we're seeing shares rally as a result of these better than expected results. So again, a name to keep on your radar here this trading session. Well, we are just minutes away from the opening bell on Wall Street, taking a look at how the trading day is shaping up. You got the Dow, S&P, and Nasdaq all on track to open the trading day in the green. We'll be right back.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Welcome back, everyone. We're just seconds away from the opening bell. Well, about 90 seconds. But anyway, taking a look at things right now, and the future is shaping up, looking positive across the Dow, the Nasdaq 100, and the S&P 500 as of right now.
Yeah, Brad, some critical levels here to watch in today's trading session. We've been talking a lot about the recent rise that we've seen within the S&P. You can see yesterday it closed above 5,200, the first time we've closed above that level in just about a month. And we are pushing to the upside here ahead of the open, just about 20 seconds here from now. So we are looking at gains here at the open for the S&P. And then also the Nasdaq 100 futures also pointing to gains here. A lot of the emphasis is going to be on tech. We have certainly started to see some cracks in terms of the AI story. There certainly are outperformers, others that aren't exactly living up to expectations. So of course, as we look ahead to NVIDIA, we got 90% of the S&P 500 companies already reporting, but perhaps the most important, we have yet to get those results.
You said the magic word, NVIDIA. My goodness, everybody should have a t-shirt that says that at this point. But anyway, taking a look at the bell ringers at the NYSE and the NASDAQ. You got Zeekr at the NYSE, and at the NASDAQ, you got Man a Doctor. All right, a lot of funfetti, claps, a cheer, and is that a squishmallow of a cat? I don't know. We're going to see and explore that a little bit more. But ticker symbol MNDR, ringing the opening bell there. Let's do a check of the markets, sponsored by Tasty Trade. No squashmallow cats there. ultimately taking a look at utilities, once again leading the pack. We did a deep dive on utilities this week here, so you can go back, check out that video on the Yahoo Finance platform. But take a look at the year to date. We'll give you a brief version of what we were seeing and talking about during that chat. 13% higher year-to-date utilities. More green than negative. That's a good thing for us here on this Friday. However, one of the other names that we talked about in that chat in utilities and tangent was Staples. However, that's moving to the downside right now out of the gate.
Giving back some of those recent gains that we've seen over the last couple of weeks. All right, let's get over to Jared Blickery, who's standing by here with a closer look at some of those movers here at the open, Jared.
Thank you, Shauna. And let me just stick with sectors here, but I'm going to show you what's happened this week. So this is 5 days. We have utilities. Surprise, surprise. That is in the number one spot. That's up almost 5%. By the way, this is the best week for utilities of 2024. That's in the upper left. Also for materials, that's XLB. Also for financials, and we're not seeing, yes, we're seeing that in the number two position today. So the three leaders for the week just had one of their best weeks of the year, and we're seeing everything in the green for the week. So just tacking on gains there. S&P 500 and Dow are now within spitting distance of their record highs, and the Dow has been green every single day this month, every single trading day. So we'll have to see what comes of that. Here are our leaders for the week, and we can see oil is in the number one spot. That's small oil producers. That's up 3.2%. Then we have momentum up 3%. Stocks at the chip stocks, those are up 2.3%. So the list goes on. The worst position here was ARC, and let's take a look at that real quickly. We can see unprofitable tech has been a little bit unprofitable this week. Roblox down 21%. That was an earnings story. And I want to leave you with the miners here. I've been tracking gold and copper miners. These guys have been on fire. We see gold, GOLD, that ticker up 4.7% this week. SLV, that's a silver ETF, that's up 7%. So all in all, we're seeing the miners just kind of in concert with some of these precious metals and not so precious metals just surge to records or near records.
All right, Jared, thanks so much for breaking that down for us here. Let's stick with one of the big themes that we have been talking about here at Yahoo Finance, and that is AI. AI has been in focus this week as investors digest a slew of results from the likes of ARM Holdings, Taiwan Semiconductor, and SoundHound AI. It's been a mixed picture, especially when it comes to guidance. But our next guest, though, saying that there is a tidal wave underway. There are some key names that are going to benefit. For more on this, we want to bring in Dan Ives, Wedbush Securities Senior Equity Analyst. Dan, it's good to see you. So talk to me about this note that you just put out this morning. The title of it almost says it all. AI revolution spending tidal wave is well underway. That's been seen in Q1 results. What does this then signal, though, about the outperformance then of some of these names to come?
Look, I think it shows this revolution, the monetization is actually now starting. And it's not just about Godfather of AI, Jensen, NVIDIA, and what Nadella is doing to Redmond. Now it's the rest of tech. I mean, I think names like ServiceNow, Salesforce, Oracle. You look at ARM Holdings. I mean, those are just robust numbers. You're seeing it play out across other areas, Palantir, SoundHound, and what I believe is going to be the rest of software and semis. I think this fourth industrial revolution has begun.
How can investors best determine a healthy amount of spending on generative AI ambitions versus what seems unhealthy or perhaps over-indexed capital allocation?
Look, if you look at these hyperscale players, Microsoft, Amazon, Google, and then you analyze some of the spending that we're seeing from Meta and others, it's just begun. I mean, we're not even in first inning. I'd say we're in the dugout in terms of where this is all going. Now, in terms of over-indexing, I think you have to own the right plays. I think you have to have your plays in semis, software, and infrastructure. And I think there's almost a basket approach to this. But even if someone told you 6 months ago Dell would be an AI play, you'd say, okay, you must have had a really good Friday night. But look what's happening. Look at Dell, Oracle, and others. This is a 1995 moment, not a 1999 moment.
Dan, one of the names that we've been talking about a lot when it comes to AI, at least most recently, not so much here over the last several months, but most recently it's been Apple. Questions about what exactly their AI strategy is going to look like. We're expected to hear a little bit more at the big event next month. But I'm curious from your perspective, what do you anticipate to hear from Cook & Company in terms of what their strategy is going to look like?
Look, I think it's probably the most important event for Apple that we've seen potentially in a decade. because this is going to be Cook laying out the AI strategy on the services side for developers. What I believe is really the start of an AI app store in terms of how that's going to morph. And then it's proprietary AI technology in iPhone 16, which will launch in September. Look, behind the scenes, were they behind when it came to AI? Yeah, but I think they've quickly caught up. And you have the best install base, 2.2 billion in the world. So this is the start of AI coming to Cupertino.
Does this compactor ad matter, Dan?
Look, first of all, for Apple to actually apologize is rare. But I think it also shows they're under the microscope. Brussels, Beltway, Target on their back. But when you make the best products in the world and you have the spotlight on you, that's what they're going to do. And an ad like this, I wouldn't expect too many more of these. But Apple's apologizing for the best products in the world, and that's essentially what they're doing.
How quickly do you think it's going to impact then their bottom line?
Look, I think when you look at the broader story here, this is probably going to be the last quarter of negative iPhone growth. And then it's the renaissance of growth that's going to happen in Cupertino. I think it's really an iPhone 16 AI supercycle that's going to play out. I think Apple is where Meta was 18 months ago. I mean, New York City cab drivers bearish on Apple. I don't think numbers are reflecting what ultimately is going to happen on the services side, on this iPhone growth story, and then you combine AI. I think we're seeing here a year from now looking at this more of a golden buying opportunity rather than the time where this is going to be a structural decliner.
Dan, while we have you, we were discussing earlier in the show about the moves that the Biden administration is prepared to make with regard to EVs and how this could impact some of the companies in your coverage list. We think about Tesla most notably here and what could happen if China decides to retaliate with some action of their own.
Well, that's the broader worry, retaliatory, and obviously Tesla front and center there. Look, the issue here is, and I've seen it firsthand throughout Asia and China, when you look at BYD, NIO, many others, I mean, these are phenomenal products, phenomenal models, technology. And I think Biden administration recognizes with the 313 area code focus so much on EVs, they got to put, some tariffs and restrictions, but you can't, it's not going to stop the freight train. I mean, you are going to see Chinese EVs come here at one point. They're going to be successful. But I think for Tesla, they're navigating their problems in China. I do believe they will start to turn the corner as we get into the next few quarters.
I see the Mets. I see Penn State represented behind you. I don't see any Knicks gear. I see the Islanders as well here, Dan. So
we got Knicks gear.
Okay,
we got Knicks gear right here. Look, again, betting against Apple, it's like betting against Brunson in the playoffs. It's just that's just not something you want to do. You don't want to awake the goat. And that's what we're seeing with Brunson. We're going to see with Apple.
Wow. Already goading him. Okay. All right. Dan Ives, Wedbush Securities Senior Equity Analyst. Dan, great to speak with you as always.
Thanks.
Enjoy the game. Thanks. Sweetgreen shares jumping this morning after raising its sales forecast. We'll speak with the company's CEO on the other side of the break.
Sweetgreen shares are surging this morning, up just about 38%, the biggest intraday move that we've seen in more than 2 years. Now, this comes after revenue jumped 26% in the first quarter from a year ago. Sweetgreen also raising its sales projections for the year, now seeing a same-store sales growth of as much as 6%. For more on these results, we want to bring in Jonathan Neiman, Sweetgreen's CEO. Jonathan, it's great to have you here and great to talk to you. Congratulations on your strong quarter here that you just put up.
Thank you so much. I want to thank our whole team for all of the hard work.
Jonathan, let's talk about what you are seeing in terms of these numbers. Clearly coming in better than expected. You're raising your guidance here for the quarter, and this is on the back of what has already been a tremendous year for your stock. Right now, you have shares up nearly 200% since the start of the year. What does that then tell us about the state of the consumer today?
You know, we had a really strong quarter. We grew 26% year over year. We expanded our margin to over 18% at the restaurant level, and we comped 5%. So we think that the consumer is still very resilient, and we're very excited about some of the things we're putting out there. You know, we just launched steak this week on Tuesday. We launched a grass-fed, pasture-raised steak and had a record day for the company on Tuesday. So a lot of good momentum all around.
We're going to get back to that steak, Jonathan. Oh, you trust us. But the loss from operations, that was really interesting. Trimming that from what you saw a year ago. At what point do you think you'll be profitable on your operations basis?
So we are guiding to adjusted EBITDA profitability this year, which is, we've had a huge inflection in the business as we've continued to grow our sales, expand our margin, and hold our G&A relatively flat. So a lot of leverage in the business and looking to continue to build on that momentum as we deliver more stores around, we open more stores around the country.
Jonathan, when you talk about that future momentum here, you've also been testing out automated salad-making machines. What does the plan look like in terms of further adoption there? And ultimately, what is that going to do in terms of the profit margins and your ability here to better control some of those costs?
We're very excited about the opportunity with automation. So we've been a leader in automation. We have two pilot restaurants today. The first one actually opened a year ago today in Chicago. We have a second one open in California. The technology is called the Infinite Kitchen. And so what we've said in the past is that we expect at least 7% margin improvement at the restaurant level from this automation. But more importantly, it's about the customer and team member experience that is improved. So customers get their food faster, they get it perfectly portioned, and team members get a better experience, a better restaurant to work in. So we've seen far less turnover. What we did say is in Q1, we saw the two restaurants have a 28% margin, so about 10 points better than the fleet. And we are guiding to about 7 new restaurants featuring the Infinite Kitchen this year with 3 or 4 retrofits. Over the next few years, we do expect to kind of take that up each year, the percentage of restaurants that have the Infinite Kitchen, as we continue to learn more and scale the technology.
Jonathan, you're scaling the menu as well here. Steak, let's get back to it. Why now, and what would you look to determine whether or not it's a success upon market entry and delivering that to so many customers?
Absolutely. So for Sweetgreen, we're all about meeting customers where they are, and steak has been something that customers have wanted for a very long time. You know, we do believe that a protein-rich diet is very, very good for you. So we've been leaning into protein plates, really expanding our customer base, and trying to win more dinner business. And so steak is another strategy around that. We've introduced a grass-fed, pasture-raised steak. Customers have loved it. We tested it in Boston for a few months, saw almost 20% of our orders featuring that item. And on Tuesday when we launched it, the company had a record day. So we're seeing a lot of positive momentum with steak, again, expanding the customer base, driving that dinner business, and showing that Sweetgreen isn't just a salad place.
Jonathan, you've talked about the new menu items that you've added, the new stores that you're planning to add, how you're trying to incorporate here automation into your restaurants. What is that all ultimately then going to do in terms of that timeline to profitability? What does that look like here?
So as I mentioned earlier, we do expect to be adjusted EBITDA profitable this year. We have not guided to a timeline on net income profitability, but you will see significant leverage on the business this year as we continue to grow our top line and hold our G&A relatively flat.
Jonathan, we've been trying to wrap our heads around what return to office means for some of the lunch orders specifically, and whether you've seen the continuance of some of the kind of hybrid model actually be a benefit to Sweetgreen's business as people are just looking to be able to pick up regardless of whether they're going into a physical office or if they're working from home. How have you seen that kind of moderation in lunch orders? And, how does that also permeate over into the dinner profile that you're trying to also cross over into?
Traffic patterns have changed so much since before COVID. And, I think the world has stabilized quite a bit at this point. We have seen continued momentum in our urban store base, but the patterns have changed. Holidays are different. You have Fridays are still not huge in the office. And so the company has evolved, and we've built out our delivery business in a significant way, meeting customers at home, specifically in the suburbs. We've had a huge focus on dinner, which is a bigger occasion in the suburbs, but also seen some nice momentum in urban as more companies are deciding to get back to the office. So overall, seeing some really positive trends across both urban and suburban parts of the business.
All right, Jonathan Neiman, who is the Sweetgreen CEO. Jonathan, thanks so much for taking the time here today. Appreciate it.
Thank you for having me.
Absolutely. We'll talk soon. Yelp shares slipping after issuing lighter forecasts for the second quarter, disappointing investors. The company did see revenue climb 7% from a year ago in the first quarter. Take a look at shares right now. They are down by about 1.5%. One of the huge things that a lot of investors will remember over the course of this year, this company has had some challenging times. It's down by about 15.5% year to date at this juncture. So this just another notch in the wrong direction right now.
Yeah, certainly. And this is also a continuation in terms of the likely trading action that we've seen for companies that have not exceeded guidance expectations. So yes, in terms of their most recent quarter, it did come in better than expected, but guidance falling short. And we are seeing investors take a bit of issue with that, obviously further pressuring the stock price here today. But I think also just my takeaway from this is this also highlights the fact that it is a challenging environment here for consumers. We are seeing people adjust their spending habits. When it comes to Yelp, this is a good look here into how often people are eating out, how exactly they are spending, what exactly they are looking for in terms of some of those experience types of offerings here. And I think a pullback even within Yelp's business further highlights the fact that consumers remain under pressure. And this is likely going to be a headwind, a challenge here for not only names within the sector, but really across industries for the coming quarters.
Yeah, they particularly are looking across a few things. One area of strength and momentum right now in the services category, home services subcategories, requesting a quote. They're trying to push more into having the opportunity for you to identify a project and then just connect directly with anyone who might be able to service for that project and carry that out as well. So we'll see exactly what type of incremental improvement that offers for the business. But as of right now, investors not too impressed. We've got all your markets action straight ahead. Stay tuned. You're watching The Morning Brief.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
We're nearly 30 minutes into the trading day, and stocks are posting some modest gains out of the gate. The expectation for a rate cut this year now centered around September, as we've gotten some soft labor data between the jobs report last week and yesterday's jobless claims reading. And the focus will soon turn back to inflation. CPI, that's due out next week. Oh yeah, we're going to have a rockin' and ready show for you. I believe we're going to be going live at 8:30 a.m. as we always do for the Consumer Price Index. You're smiling, you're excited.
Always.
It just comes down to whether or not, if in this reading we see still signs of a strong and resilient consumer, or if we start to see cracks show up that the Fed starts to say, okay, now we can look for a trend to start to be locked in. But it doesn't seem like it's pointing that way right now.
Yeah, you're exactly right. And it's also going to be very interesting to see how the market trades on the heels of this report, whatever it may be. Because what we have seen, and you can even take a look at the market action this week, the market is clearly looking and hearing what it wants to hear. Any sort of dovish Fed speak that we've heard over the last couple of days, or anything that could be interpreted on the fact that a rate cut is still most likely and still on the table, that has been enough to boost the markets over the last several days. You have the Dow closing up 7 days in a row. When you take a look at today's move to the upside, we could see 8 straight days of gains. You've got the S&P, the Dow also on track here for further gains, possibly here to the upside. The S&P back above 5,200. So that's a lot of this future momentum, at least in the short term, is going to be resting on what we hear from that CPI print. And Bank of America was out with a report here this morning, just being a bit cautious just in terms of what we are likely to hear. They do expect a bit of a moderation here, at least when it comes to the month-over-month percentage change for the core inflation print. They expect that to climb about 0.3%, so a bit of an improvement here. But yet that's not going to give the Fed most likely the confidence that it needs in order to really talk about cutting and give it the clear green light here to cut. So what exactly they need to see, the material improvement, that still remains to be seen. But again, we are getting Fed speak, and we'll get more today on both sides of the aisle, kind of straddling that, because I think everyone's having a very, very tough time trying to figure out what that next move should and will be, and the timing of it.
I think you mentioned the key word, in moderation, and we're hearing that word show up from the NRF this morning as well, with their most recent release looking at, and this retail monitor that they have, looking at specifically where retail sales grew. And they said it grew modestly in the month before, or from the month before in April. A shift in the timing of Easter appearing to be behind a slight year-over-year decline, they noticed there. But ultimately, in the statement from NRF President and CEO Matthew Shea, he said that the ability to spend is supported by a growing job market and real gains in wages. Overall inflation remaining stubborn because of elevated prices for services, while inflation for goods has dropped to nearly zero here. So consumer spending continuing to be driven and driving economic growth and retail sales increases, though, coming back to that main word, they see some moderation in spending as consumers continually search for value right now.
And we'll be getting another read on the consumer here in just a few minutes. Coming up next hour, Madison Mills will be here with me for our new show, Catalyst, where we will be breaking down the Fed's timing, pace, and change of policy easy, potentially.
Love it. I tune in every day. Plus, our 11 a.m. hour, stay tuned for Wealth. We're going to be discussing just how strong the consumer really is. Yes, a continuation of this vivid chat that Shona and I were just having. We've got much more here on Yahoo Finance. Stick around.
It's 10 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills, and welcome to our new show, Catalysts.
From equities to commodities, we're decoding trends and uncovering the movers behind today's market moves.
Our team of experts are here to help you navigate all the possible outcomes, help you make the best decisions for your portfolios.
It's Friday, May 10th, so let's dive into the catalyst moving markets today. Stocks are poised to end the week on a high note. The Dow looking to notch its 8-day winning streak, and the S&P 500 heading towards its third week of gains. Both the S&P 500 and the Russell 2000 moving back above their 50-day moving averages, indicating a market that could be continuing to broaden.
Plus, investors optimistic about rate cuts following slightly weaker econ data and recent Fed speak. Atlanta Fed President Raphael Bostic saying in an interview with Reuters that the Fed is on track to cut rates this year, but timing is uncertain. Investors were hoping Fed Governor Michelle Bowman was going to speak on the timing of rate cuts today, but she didn't offer any guidance. We will also hear from Chicago Fed President Austin Goolsbee and Vice Chair for Supervision Michael Barr later this afternoon.
And Tesla is looking to expand its supercharger network. CEO Elon Musk writing on X that the EV giant will spend, quote, well over $500 million to create thousands of new chargers this year. And this comes after the company slashed nearly 500 jobs from the people who ran that business just last week. Meantime, President Biden is set to unveil new China tariffs as early as Tuesday. That is according to several reports.
We want to get to some breaking news on consumer sentiment. A bit of a miss here for the month of May. The preliminary reading for May consumer sentiment falling below expectations to 67.4. The sentiment falling to the lowest reading that we've seen in just about 6 months. But I also want to point out the inflation expectations, because that's really, I think, what's driving the immediate reaction that we're seeing here in the markets. Inflation expectations during the next year, that's higher, rising to 3.5%. That was up from 3.2%. And then when you take a look at the expectations for the next 5 to 10 years, that rose to 3.1%. So taking a look at the market's initial reaction, we are off the highs today. We did see the markets give back some of those earlier gains. We have the S&P 500 right now trimming their gains to just about 0.3%, Maddie.
Yeah, it was interesting, Shauna, seeing the S&P kind of coming down to the 0.2% range. Now it's popping back up off of those lows, but still not at their highs of the day. Also taking a look within this report, we're seeing similarities between all political parties in terms of that consumer sentiment. Republicans and Democrats both feeling less positive in May. So a lot of kind of negative data to look at in this print, honestly, when it comes to how the consumer is feeling about the economy. And inflation, again, not falling as rapidly as it did last year. And consumers obviously here taking notice. The latest University of Michigan survey here showing that consumers expect inflation to hit 3.5% in the next year. Obviously, that's not the 2 number that the Fed is looking for. Worsening inflation could be the headwind that stalls market momentum as well. At least that's what our next guest has to say. He's joining us now. We've got Mark Pinto, head of America's equities at Janus Henderson Investors. Thank you so much for being here with us this morning. I mean, talk to me about your reaction to this print. Is this surprising to you?
Well, I think the consumer has definitely been a little bit weaker since 2021, and we've seen spending in discretionary categories not quite at the levels that we saw or during the pandemic and coming out of the pandemic. We're definitely seeing examples of consumers trading down, looking to buy, better priced items and maybe not getting the premium product. Where we are seeing the consumer spend a lot of money, however, is in travel and leisure. It seems that consumers are gravitating more towards experiential spending, if you will, rather than buying hard goods. So in general, I think the consumer's health is pretty good. The well-being index, which is a tracked measure of consumer strength, is close to 99. So, the consumer is in decent shape, but they're definitely being selective in terms of where they spend their money.
I'm curious, Mark, you're reading just in terms of the timeline of that rate cut. Do you still believe, given the fact that we are starting to see some weakening, I think it's fair to say, within the economy, at least the most recent prints that we have seen, is it still too early to cut rates at this point?
Well, as you note, the April jobs report was definitely weaker than expected, with 175,000 new jobs. And I think even more importantly, wage inflation moderated a little bit. So, you take that and you can also add the fact that second quarter GDP got revised down to 3.3%. It does seem like the higher rate policy is starting to impact the economy on the margin. And from our standpoint, that actually sets up the backdrop for a possible rate cut. And honestly, can't tell you whether it's going to be June or September. But Chairman Powell was pretty clear in saying that it's a very high bar to take rates higher, which makes me believe the Fed is looking more at cutting than anything else.
I'm curious then, does the Fed care that consumers think inflation is staying above 3%? That's not the number they want.
No, they clearly want it below 3% and as close to 2% as possible. I think they're obviously tracking all the different metrics. I think wage inflation, from our vantage point, is one of the most important ones. And again, as I said in the April jobs report, we saw that wage inflation moderated. Obviously, there are parts of inflation that are out of control of the Fed, whether it's energy prices, housing prices. Those are, more driven by externalities and cyclical factors. But, I think, look, the Fed is trying to manage the mandate between keeping inflation in check, but also keeping the economy on solid footing.
You mentioned some of that sector performance, and we know that utilities are up 8% this month. Do you read that as a flight to safety or as evidence that the rally and the momentum that we're seeing is starting to broaden?
Well, we've been wondering when we would see a broadening in the market. The Magnificent Seven were clearly a major driver of the performance in 2023. The S&P is up 10% year to date, and it is a broader rally, but we're still seeing a lot of strength in the growth, technology, and healthcare areas. So I think the market actually is showing a lot of resilience in this uncertain period in terms of rates, and I don't think that if you look at the behavior of the market in different sectors, we're seeing some very good results. Q1 earnings were very strong. Overall EPS was up 5%. Most companies beat expectations. So it doesn't feel like a defensive market to me. And so utilities could be, having their own individual drivers, but I don't think it's an indication that investors are looking for more conservative types of bets.
Yeah, Mark, that was going to be my exact question there. And then building further upon that, when we talk about the shift that we have seen to these defensive plays, it sounds like it might just be a rotation into those that had underperformed here since the start of the year. What does that, though, tell us about the likely action or the likely allocation that we will see in terms of market leadership from here on out?
Well, I think people, this is a growth-oriented market. Growth stocks have outperformed value for quite a time being. We've got some major secular trends going on, whether it's artificial intelligence, innovation in healthcare, and the growth in biotech, and the meeting of unmet medical needs with new therapies and companies. So it doesn't seem to me like it's necessarily that people are shying away from the growthier parts of the market. There's some very powerful trends that are driving the market higher, those that I mentioned. And by the way, those seem we're getting the benefit of that growth even in a high rate environment. So I think the market's been incredibly resilient given the uncertainty over interest rates, and that resilience has translated into investors not taking a defensive posture. And yes, there has been a little bit of catch up, as you noted, with the broader market sort of trying to catch up to the highly concentrated big holdings at the top of the S&P 500. But I mean, those companies are still doing really well, whether it's an Amazon, Microsoft, or Nvidia. They're putting up some very impressive numbers, and investors are staying invested in those names.
Many investors are excited looking ahead to NVIDIA's next print here in a couple of weeks. All right, Mark Pinto, we have to leave it there. Head of America's Equities at Janus Henderson Investors. Thanks so much for joining us.
Thank you for having me.
On top of gains for the broader markets, we're looking at some big moves in metals. Gold prices hitting a 2-week high. We are going to take a closer look next. You're watching Catalysts.
Let's do a check of the markets here, sponsored by Tasty Trade. Looking at green across your screen. You've got the Dow up 140 points here. You got the S&P 500 teetering around 0.3%, and the Nasdaq up 0.1%. We're still seeing more momentum coming into the flows when it comes to the S&P and the Nasdaq following that consumer sentiment print, which is very interesting to me. I would have thought that the consumer feeling less good about the economy would potentially be a sign of the markets kind of questioning what the Fed was going to do with rates here, but we are seeing the move to the upside moving forward for the markets here. Shauna.
All right, looking at gold futures on track for its best week since early April as rate cut hopes are lifting metals across the board. For more, we want to bring in Bob Iacchino of Path Trading Partners, co-founder and chief market strategist. Bob, it's great to see you. And so talk to me just about this rally, let's call it a rally, that we've seen in gold this week. We certainly have seen gains in terms of how much upside momentum is left, because you talk about the fact that clearly the Fed's path forward here is driving and influencing the price of gold, but you also have got the central banks around the world buying gold and that being a real driver here. So then what does that upside look like, if there's any?
Well, to your point, according to the World Gold Council, largest purchases ever by central banks, largest purchases on record. I guess in 700 BC, maybe a central bank then could have bought more, but for the record that we have, first quarter, largest central bank purchases. So we have that. The second thing we have is what I believe to be a reflation narrative just generally across the economy. And people think gold's an inflation hedge. It is not. What gold is a store of value or an asset. Anywhere you store money is an asset. Your home, land, the stock market. Now, that doesn't mean they come without risk, downside risk. All of those I just mentioned do, and gold does as well. To a certain degree, Bitcoin is a high beta store of value. Gold is the same. And if inflation is picking up again, which I believe it is, gold will rally as a function of asset inflation. We all complain about inflation. I do as well. I bought a bunch of steaks yesterday. Really pissed me off. But when you look at asset inflation that comes with it, those of us that own assets like gold, we benefit from that. So my target for gold is about 4.8% higher from here, very specific, 2491. And if you get to 2491, the speculator will probably push it to 2,500 just because they like those numbers.
So sticking with gold there, I'm curious, the Chinese central bank is slowing its purchases of gold. I wonder to what extent stateside buyers of gold, the people Brian Sozzi loves to talk about going to Costco, getting those gold bars, do they need to worry about that slowdown from foreign central banks?
That's funny. That's where I got my steaks. They don't need to do that as long as we're going to get this Fed rate cut. My job as a strategist is to figure out what's going to happen, not what the Fed should do or what markets should do, but what they're going to do. I think the Fed is going to cut rates. The probabilities are rising of that just based on market pricing. Cut rates. Did I say raise? Cut rates. And if they do, that will boost gold, because the only time that gold suffers in an inflationary environment, which I believe we're still in, and we're probably getting a little bit of an uptick on that, is if the Fed is fighting inflation. And right now, the rhetoric has pivoted to the opposite of that. So despite central banks slowing, China being the main one, as you mentioned, Madison, I don't think that's going to slow gold all that much. It's just going to slow the rise, but I think the rise will still be in place.
Bob, how are you looking at the pickup in buying that we've seen in silver, and a lot of that on the back of this rally that we've seen in gold?
Yeah, that gold-silver ratio can really widen out, but it really is sort of a tug on the rope from gold. And it's sort of an elastic rope, right? Silver will snap back. Silver gets looked at by a lot of speculators and people who want to store in precious metals as the poor person's gold, for lack of a better phrase. My biggest losing trades have been in silver. And it's simply because I don't understand the juxtaposition well enough between the industrial properties of silver and the precious properties of silver and which one dominates when. However, in a reflation narrative, when you're starting to see US PMIs, manufacturing PMIs specifically, go back into expansion territory, silver's now benefiting from both of them. Again, I'm not in it because if I get in silver, it'll be a losing trade. That's just the way it's been. But from that perspective, I think silver's playing catch up, but also benefiting from the environment that we're in because of that dual nature of it.
Right. Well, it's interesting because you are missing out on some of those big gains year to date, unfortunately for you, Bob. But
Not the first time, Madison.
not the first time for many of the investors who chat with us, but I'm curious, we're not seeing a lot of the traditional hedging activity that you think of when you think about investors who are concerned about the momentum of a market. We're not seeing people buying volatility, for example, with the VIX. Why is gold a better hedge?
Well, I don't know that it is a better hedge. Again, I think what it is a lower risk asset that could benefit from inflation and reflation. So really, I don't know that it is a better hedge for equities falling. It may not be at this point, but if equities were to drop, then you're likely to see the Fed cut more aggressively, and that would benefit gold simply on dollar weakness. Gold has probably 4 factors that move it in the short to medium term. 3 of those, in my view, are pointing to gold being higher. Now, I own gold, full disclosure, I've owned it since November 2022, so I don't want anyone to take that and run with it so that my trade gets better. I just think when I analyze it, there's only one way that gold comes out in the negative, and that's if inflation spikes and the Fed decides to tighten and fight it. Gold will suffer then, and I don't really see that happening in the near future.
All right, Bob, we're going to have to leave it there. Thank you so much for joining us. We really appreciate it. That was Bob Iacchino of Path Trading Partners joining us. We're watching Moderna shares after the company announcing the FDA has delayed the approval of its RSV vaccine to the end of May. Yahoo Finance's Anjali Kemlani joining us now with the latest. Anjali.
That's right, guys. So the FDA let Moderna know that even though they were supposed to have a decision by this weekend for that RSV vaccine, they're going to have to delay it due to administrative constraints until the end of May. Now, this doesn't fully throw the approval process off track. The CDC is still on track to get to their portion of the approval process in June. So it doesn't totally throw off the timeline, but it does put a little wrench in the overall timeline for Moderna, which has been waiting to get this product to market to make it the second product that it gets revenues out of. So that is the only concern for this right now. While it doesn't throw off the entire process, it does put sort of a little tiny dark cloud over Moderna for the day.
All right, Anj, thanks so much for breaking down that story for us, and certainly a trade here that investors should continue to watch. All right, let's also take a look at a company that's making its public debut here in the U.S. today, a Chinese EV maker set to start trading on the New York Stock Exchange. Zeekr will be the first major Chinese EV maker to go public since XPeng and Li Auto went public just about 4 years ago. The car maker set to sell 21 million shares. They're priced at $21 a share after the close last night, pricing at the top end of the range. I'm taking a look right now at the latest developments that we're getting. Looks like it's indicated to open right around $23 to $25 a share here. We're waiting for the opening trade here of Zeekr. But Maddie, we bring this up in the context of what this means for so many other companies that are already within this space. Obviously, specifically Tesla is the name that comes to the top of mind for many people when you think about another competitor here within this space and now going public. The real threat is viewed at least to Tesla and Zeekr posing that huge competition. In a recent interview, their CEO was saying that their sales gap with Tesla keeps narrowing, was very optimistic about the company's plans to expand in Europe and in Latin America this year. So that also just speaks to that competition side of the story. And then you also can talk about the pricing wars and exactly what that ultimately means for so many of these larger U.S. auto giants here in the U.S. as well.
Well, it's really interesting that you bring up the pricing wars because Zeekr is going to be impacted by this announcement from the Biden administration expecting to put tariffs on Chinese EVs and those automakers there. Now, the parent company of Zeekr has previously indicated that they're going to subscribe to 90% of the stock, indicating that there's a little bit of stress coming into this IPO. And that's no surprise, given that we've got this news from the Biden administration today. It was probably a good move for them, given that those geopolitical tensions between China and the U.S. are headwinds that are unpredictable and that are unfortunately going to weigh on the stock as they IPO today. So seeing some stress across the board there. But staying in the electric vehicle space here, we are going to move on to our next guest in this space. Tesla CEO Elon Musk posting on X saying Tesla will spend over $500 million expanding the supercharger network to create thousands of new chargers this year. This comes after the electric vehicle maker laid off the employees who ran the EV charging team. To break down what's next for Tesla, we have Mike Ramsey, Gartner automotive analyst. Mike, thank you so much for joining us this morning. Listen, we got great news to talk to you about, so plenty to dive into. I mean, talk to me about this U-turn from Elon Musk. What do you make of it?
Well, I mean, actually, to be honest with you, this announcement makes more sense than the layoffs do. The supercharger network has been one of the most important assets that Tesla's had in terms of differentiating it between the other automakers and why buy a Tesla. And they just spent the last year essentially getting all of the other automakers in the United States to switch over to the type of charging plug that they use. And by doing that, they actually open up that network to become a significant source of new revenue. So the layoffs, maybe that is a cost optimization effort as they try to get their operations in line. But the investment in the network actually makes a lot of sense and might be a real benefit to them in the long term as a new source of revenue.
How long does something like this, do you think, take to build out? What does the timeline look like, given obviously they clearly have experience, but they're almost starting from scratch in a sense?
Yeah, there are a lot of things that go into it. Obviously, you need to work with utilities to make sure that there's enough high power connection to these sites. And you also have to get the real estate that is in the right place. So, I mean, to build out $500 million worth of infrastructure is probably a good solid couple years of work, but they do know what they're doing. And I promise you that they've already done the real estate scouting for almost every spot in the United States, at least, to find the best locations for superchargers.
Well, this announcement from Tesla coming after BP was very excited to try and pick up some of the EV charging real estate in the U.S. left behind by Tesla after those layoffs. Does BP stand a chance here?
Yeah, listen. I mean, it's not exactly like the liquid fuel refueling market, but especially at the beginning, it was very different. But as we mature, and these superchargers, meaning like really fast chargers, they are a lot closer to that market. I do think that there's going to be more parallels, and just like there's more than one oil company, and there's more than one set of retailers. Once everybody starts using the same plug, then there's room for everyone to compete in this market.
Let's talk about one of the other big question marks that's hanging over the heads of a lot of investors in Tesla. It has to do with their automated driving, their full self-driving. And Elon Musk was out earlier this week, last night, saying that he's actually saying that the Cybertruck full self-driving is only a few months away. How realistic do you think that timeline is? And just give us your sense just of where Tesla stands within this race in full service driving here and self-driving here, and what exactly that ultimately means here for the space at large.
Yeah, I mean, it's really important too. And I think this is very hard for people to get their head around, because Tesla's autopilot and their full self-driving software works pretty well. And to most of us, we think you get behind the wheel and it can do a lot of automated functions. You think this is a self-driving vehicle. It's not, okay? What they are charging for, what they're charging customers for, is a partially automated system that is more like a convenience feature. It is not a self-driving vehicle like something that Waymo is offering in the Southeast United States and in San Francisco. So when Tesla talks about this service improving and rolling out, they are not really playing in the same field as many of the, I would say, fully autonomous RoboCab type providers are playing. That said, their system keeps getting better and better, and they can make money selling it because it's a nice feature and that people like to have. And they've promised, Tesla has promised that in August, they're going to unveil their new RoboCab that can, essentially be a full self-driving vehicle. My expectation is that vehicle will not be the same thing that you and I can buy, or even the Cybertruck full self-driving. This will be a vehicle that has a lot more equipment on it, more computers, more sensors, things that are not part of a standard Tesla self-driving vehicle.
So, Mike, just taking a step back, one thing that confuses me about the challenges that Tesla has faced is that Elon is in a world where this technology is existent from some of his competitors. Why not just go get those people who can make Teslas get on board and kind of get a step ahead in this EV full self-driving race? What is it about Tesla's approach that is different than those other competitors in the space that could be the reason they're a little bit behind?
Well, I think that they've always done the same thing, which is they want a low-cost, high-volume approach. So they're looking at it like, hey, how can we get this system into the hands of as many people as possible using the cheapest equipment as possible at scale, and then try to, I don't want to say crowdsource data and behavior to keep improving our system. That way of doing it, it can provide a system to you and me that feels nice, but is not really safe. And they've been very clear about putting a system out there that requires the driver to still be paying attention. It can do a lot of things, but you and I have to jump in if something goes wrong and take control of the vehicle. The other people that they're competing against are not trying to do that. They are trying to create a fully automated system where there is no need for a driver ever. So they have way more compute power on there. They have redundant systems. They have way more sensors. In other words, they have a much, much more expensive product out on the road than what Tesla is trying to do. So when Elon says, hey, we're going to be able to do this, what he's doing is kind of effectively like saying, hey, I'm going to try to take a wedding pictures with my iPhone versus having a professional photographer out there with a $20,000 Nikon shooting. That's what we're comparing. Now, that iPhone camera keeps getting better and better, but it's still not the same as a professional camera. And that's kind of what we're talking about when Tesla is talking about doing full self-driving. They're trying to do it with cheap equipment that you could find on a regular car, not with the $250,000 package that Waymo would have on its vehicle.
Mike, you know I love the analogy. I appreciate it. Last quick question for you. We know that Elon was just in China. I'm curious regarding these tariffs. If we do see a retaliatory move from Beijing, to what extent is that a headwind for Tesla?
Yeah, I mean, I definitely think that there is potential for Tesla to continue to struggle in China, and if there are additional tariffs put on them, it could definitely affect them. That said, I think that Tesla's bigger problem in China is that the Chinese automakers continue to get better and better, and they can offer lower priced vehicles that are very competitive. And unlike in this market where Tesla really is a dominant player, in China, there are a lot of good players. You mentioned one, Zeekr is just one of many that are offering EVs in China and at a much lower price point. And also, importantly, these vehicles look good. This is not China 10 years ago. You know, the vehicles have slick designs. They have nice interfaces on the interior and even have some features that Tesla doesn't have. So that's going to make it a tough environment, particularly if the government retaliates with some sort of tariff that would make it more expensive for them to operate.
All right, Mike, we got to leave it there. Thank you so much for joining us. This is a great conversation. Really appreciate you. That was Mike Ramsey, Gartner's automotive analyst. Well, Gen shares are up after the company reported results topping earnings and revenue estimates. This is the top performer in the S&P 500 this morning. Those shares up over 15%. And this comes after a challenging year-to-date performance for the company stock. It was down about 13% heading into the print. So for more on the quarter, we are joined by Gen's CEO, Vincent Pilette. Vincent, thank you so much for joining us here this morning. Talk to me about what the market was missing heading into this print, because that year-to-date performance was tough, and now you're recouping those gains here to the upside. What do you make of that?
Absolutely. And, you know, about 18 months ago, we closed the merger between Avast and NortonLifeLock to create Gen Digital. As you know, we merged two big leaders to become like the leader in consumer cyber safety for the individuals. As always, when you go through merger, you have a set of challenges and opportunities. Yesterday, we reported our first full fiscal year as Gen Digital, and our numbers, our performance was very broad-based across the board. We posted record revenue, record profitability, record cash flow, and really supported by the demand with growing customer count. And I think the investor, it was nice to see this morning, are recognizing the opportunity that we see. The threat landscape is continuously evolving and is here to stay. And Jen is best positioned to protect the individuals.
Yeah, Vincent, talk to us a little bit more about what exactly that opportunity looks like, because I was also taking a look at the instant analyst reaction to this print, and RBC was also calling out just your next chapter and some of the driving factors that they see in terms of those new products. So what is it, and what is it ultimately then going to do for your business?
Yeah, absolutely. Still in the broad environment, people see like the protection of the individual as protecting your computer or your device, protecting you against malware. And that environment is totally shifted. If you want, the threat landscape is a lot more about anti-scam, about breaches. You can have your personal data stolen from somewhere else than your own devices, and a year later being posted in the dark web, being bought by bad actors, and suddenly you wake up and you have credit cards and mortgages taken on your name and your identity being stolen, and you don't realize it. So we've evolved our portfolio to be uniquely centric around the user and protecting your data from not only just device security, overall security, but also identity protection and restoration services, giving consumer the ability to also understand their data and their privacy features they want to have in the dark web, all the way to the ability to manage your own reputation online. I'll give you two examples of two new products we came up with. In January, we launched Norton Genie, which is kind of an anti-scam assistant you can have as an app in your pocket, and it detects anti-scam from text, from social posting, and then it has a UI, conversational UI, where you can really get more insight. Another product we came up with is Total Radius, which really scan the entire web, all the dark web about your personal data. And then it's using our 15 years of data and history, using AI technologies to detect patterns and predict the future of your reputation, and giving the consumer the ability to manage their reputation online. So we constantly evolving the portfolio. And then we came up with the overall membership concept. Norton 360 or Avast One are two of those. For a membership fee, you can have access to our entire portfolio and all the features that give you entire protection against cyber risks.
Well, that plays well into the next question I have for you, Vincent, because analysts at Barclays are pointing out that average revenue per user is the key stat to watch for your company moving forward. It looked pretty much in line with previous reports to me. So what is your hope for what those products can do to that specific data point, to the ARPU? To what extent do you think that could push that number up a little bit more?
Yeah, absolutely. And, everybody is coming at different stage of their life cycle into the cyber environment, if you want, and understanding the risk profile that they have personally based on their preferences or their own set of activities online. So we have 65 million paid customers. We have hundreds of millions of users, and some are coming with basic security needs, and they are the low end of the ARPU, and some understand the full concept of a protection, and they are the high end. On the high end of the ARPU, it's like $15 a month. On the low end, it's $5. And so our portfolio is an average. We believe that over time, even if you come at the first year of that cyber protection, as you understand more and more of the risk, as we educate you on the overall environment that sits out there, you're going to move up the value chain in terms of protection and empowerment.
Vincent, talk to us just as we zoom out a little bit, just what you're seeing in terms of the infiltration of bad actors, how big of a spike we have seen in scams, and ultimately just your confidence in the ability to continue to detect scams as they seem to be increasing at an extremely rapid rate.
Absolutely. And I think we all agree that the cyber risks are here to stay. It has moved from basic malwares to now a lot of sophisticated scam. You mentioned, phishing scams, spear phishing scams, the ability to use AI data to even target and social engineers scams that are directly targeted at you. I can take, based on all of your social media connections, a profile of one of your friends and pretend to be that to get special information from you. So I think that's rapidly evolving. We see the bad actors using AI technology to construct pictures, deep fakes, and really fool the consumers even more. And we're combating that environment with our own technology, the history of data we have. As you know, AI is basically a game of data, and we look at all of those patterns that we constantly update on a very frequent basis to be able to be at the forefront amount of that protection.
All right, Vincent, we're going to have to leave it there, but thank you so much for joining us. That was Vincent Peelet joining us from Gen. Their earnings out today, and the company up, the top performer in the S&P 500 at the moment. Now, coming up, OpenAI could unveil its own search engine as early as Monday. We're going to give you the details on that right after the break.
polarized political environment of the last several years has forced some corporate America leaders to speak out on issues. But as we head into the height of the 2024 race, the tone appears to be shifting. The Wall Street Journal highlighting some CEOs are drawing up plans to tell their employees not to expect any comments about political issues ahead of the November election. Now, this comes in light of Google recently firing dozens of employees for disruptive activities at its offices over the war in Gaza, and Google Chief Executive Officer CEO Sundar Pichai reminding employees in a memo that ultimately, quote, "We are a workplace." For more, we want to bring in our very own Rick Newman. And Rick, my question to you is, just give me your sense of how business leaders are approaching the 2024 election and whether or not we should anticipate corporate America trying to sit this one out.
Well, I think you have to define their level of involvement here. So what the Wall Street Journal was talking about is activities in the workplace itself. Are you going to be tolerating discussions of political issues, especially some of these hot button ones? Then there are campaign donations, and I have a feeling that we're going to see a robust level of campaign donations from the corporate sector this year, which we always do, honestly. They give to these campaigns for a couple of different reasons. One is obviously whether you like or dislike the candidate. there are big differences between the policies of the candidates this year, between Trump and Biden. Trump, of course, less regulation, drill, baby, drill, more fossil fuels. Biden, more emphasis on clean energy and other things we've been talking about and will continue to talk about. So there's that. But corporations also just want to kind of play both sides in elections. We see this in donations to Congress. Often they will give to more or less equally to both parties because they want to make sure they have friends in high places no matter who wins. So I think we're going to see the donations keeping up. But of course, in terms of some of these very hot button political issues, I mean, these are can't win issues. Do you favor the Israelis or the Palestinians? LGBTQ, we saw Bud Light get hammered on that last year. It's like you just can't win by taking a stand. So they just want to be as neutral as possible.
Well, I'm curious then, Rick, you mentioned the policy differences. One of the differences between Trump and Biden, of course, with taxes. We have Trump tax cuts potentially expiring at the end of 2025. What can you tell us about corporate borrowing so far this year and just how corporations are preparing for that expiration date?
Well, MarketWatch had a story recently saying that corporate borrowing is up simply because companies expect more volatility getting into the home stretch of the election later this year, and then who knows what's going to happen after November. But important to point out here, first of all, interest rates are high. This is not a great time to borrow, and most analysts, including people we have on, I think, literally every day, think we're probably close to the peak for interest rates. So it would make sense to hold off if you can on borrowing and see if rates don't come down. And the other thing is the taxes that expire at the end of 2025 are individual tax cuts that went into effect in 2018. The corporate tax cuts that were part of that deal are permanent. Now, the concern is that as part of a negotiation, if Biden wins a second term, as part of negotiations, Biden might try to negotiate a higher corporate tax rate. So you have to anticipate that. But listen, it's very hard to play an election one way or the other. And I think you're going to see a lot of companies just basically waiting, trying to do what might seem prudent, but just wait and see what happens and not try to play a Biden win or a Trump win.
All right, Rick, thank you so much, as always, for joining us. Have a great weekend. Thank
Bye,
you.
guys.
Bye. Thank you so much. Bye. Whatever. I don't know what I'm saying.
It's a candid reaction.
Bye. We love you, Rick. Thank you so much for joining us. All right, moving on to some more news here. Google might be facing some new competition in the search space. According to Reuters, OpenAI, that's the company behind ChatGPT, is set to announce its new AI-powered search engine as soon as Monday. For more on this, we're going to bring in our own Dan Howley. Dan, thanks so much for being here. This will be just ahead of a key Google event that we know is coming up next week. So what should we anticipate?
Yeah, Maddie, this is something that is somewhat almost predictable, but also obviously a massive deal. And so the thinking here, according to Reuters, and there was previously talk of this reported by Bloomberg, is that the chatbot essentially is a way of kind of trawling the internet for information to pull up data for you and give you generated content, right? So because it can do that, naturally, it's a good fit for search engines. And look, Google is doing this already with their search generative experience. I'm signed up for the betas for that, or the early access, and I do a regular Google search. And in my app, I get generative text at the top, and then links at the just below that, and then the regular links that you would get when you did a normal search below those as well. So it's something that's around. Bing has been doing this, but for OpenAI to do it, I think is a much bigger deal, just because of how popular ChatGPT is and because of how much name recognition there is now behind OpenAI and ChatGPT. And so, is this going to be something that would replace Google? That's a pretty big long shot. Microsoft is the biggest company in the world right now in terms of market cap, and they are barely making a dent at all when it comes to market share from Google. You literally say, I Google something. You don't say, I Bing something. And you probably aren't going to say, I, Chat GPT'd or whatever they're going to call it something. And so, I do think that it is interesting, though, the way that they're supposed to announce it on Monday, just a day before Google's I/O conference, where they're probably going to have a lot more news on their search generative experience. So I think overall, this is something that, is, like I said, was predictable or is predictable. It makes a lot of sense for them, but it's going to take a lot of work to try to dethrone Google.
Dan, how reliable is the information? Because I think a lot of people who even use ChatGPT, whether it's casually or even daily, there are still a lot of questions about the reliability of that information. So how big of a factor is that going to be when we talk about the potential here for future growth?
I mean, look, hallucinations, as they're called, which is just, wrong information, which is probably a more accurate way to describe it properly, they still happen, right? So it's not as though this isn't an issue still. There are ways that companies are mitigating it in some of their models. Part of that is to shrink down the size of the model, so there's less of there's not as much information, so there's a smaller chance of an error. It's more focused, and so that's some of the ways. There's also something called RAG that companies are using to help cut down on hallucinations. But I think when it comes to something like a search engine, you want to make sure that you're getting everything as accurate as possible. And so it'll be interesting to see if they've done something in some way to either fully cut down or nearly eliminate these hallucinations. Maybe work with Microsoft and Bing has helped them, or maybe they're just doing it on their own and they figured out how to do it. But it will be interesting, and obviously, if you're looking for something online, if I'm looking up, I don't know, like how to cut my cat's nails, I don't want it to say, take your cat's feet off or something like that. Like it's some kind of weird, wrong information. So they're going to have to ensure that there's a lot of accuracy there.
That would be painful.
Yeah, it seems
Yeah,
very
don't
important.
take your cat's feet off.
Dan, thank you so much as always, and thanks for all your help on my doc coming out on Monday too. I've been annoying you, so I really appreciate you.
Totally awesome.
Thank you so much. We're gonna have all of your markets action ahead right here on Catalyst. Stay tuned for more. You're looking at a little bit of mixed picture across your screen. We're gonna continue to cover all that and more on the other side of the break.
this morning announcing an executive change. Auto giant is hiring a new CFO to replace John Lawler, who will be transitioning into the position of vice chair next year. The role will be filled by former Lucid CFO Sherry House. Yahoo Finance's Pras Subramanian has the latest details on that for us. Pras.
Yeah, hey, Shauna. So yeah, John Lawler, longtime executive there at Ford, a Farley confidant, if you will, moving into that vice chairman role, kind of a second in command there at Ford to take over a lot of this strategic decisions, but beyond, the financial stuff that he was working on before, and also noting that Sherry House now has emerged as the new CFO. She left Lucid in December. We kind of figured that she was going somewhere, so now we're hearing that she's joining Ford as her new CFO. She's been around also in other companies like GM and also Waymo. But back to Lawler, he's going to be in charge of Ford's strategic development, including establishing partnerships with other companies in the EV space, right? So he's gonna help make that EV business more profitable, as they're gonna lose about $5.5 billion this year on EVs. Lawler used to work in China and Europe in those businesses, so he has experience there, sort of vital for kind of producing or striking these partnerships with other automakers. So I think that it's a potential move for him to be possibly groomed as the next CEO. We'll see when and if the current CEO, Jim Farley, decides to do something else. We'll see, but it's a good move, big move for Lawler, a well-trusted, very experienced hand there at Ford.
Really interesting, Pras. Thank you so much for joining us on that news this Friday morning. Thank you. Really appreciate it. Well, Target will not sell LGBTQ-themed merchandise in some stores this year during the Pride Month of June. This coming after the retail faced backlash for selling the products in stores last year. The company had said that backlash led to a 5.4% decline in comp sales in its second quarter 2023 earnings. Now, Shauna, lots of questions. This is Bloomberg reporting here. They said it would be about half of the stores that would not be selling the merchandise. But to put this into context, this is an extremely complex issue. Target had said that one of the reasons that they were initially taking some of the merchandise off shelves last year was because of safety concerns in some location after staff were getting threatened. They were also getting filmed on location, but then some LGBTQ employees had come out and said that the company kind of threw them under the bus. So it's a very complex thing for the CEO to have to navigate.
Very complex, and we have heard Brian Cornell try to navigate this situation. Going back to what he had said last summer, he called it gut-wrenching, just hearing about what some store employees had to confront as a result of this backlash. So where does the company go from here? In this report, Target spokesperson was very clear to say that Target remains committed to supporting the LGBTQ community. They're going to continue to have a presence at local Pride events in Minneapolis, where they are based, also throughout the country, and also remain committed to selling the Pride Month products. But I think exactly in which stores, that remains to be seen, and exactly how they're determining which stores to sell it in. That was not included here in this article. But again, Target will be selling some of these Pride supported merchandise here for the month of June. It seems like in about half of the stores, according to the report here from Bloomberg. All right, let's do a final check of the markets here, 90 minutes into the trading day. As we close out what has been a winning week here for the markets, at least for the Dow. The Dow on track to potentially close higher early in the trading day, but if we keep these gains, it'll be the 8th straight day of gains here for the Dow. We also got the S&P moving further above that 5,200 level. The Nasdaq, though, the laggard of the session, off just about 0.2%.
And coming up, wealth dedicated to all of your personal finance needs. Brad Smith is going to have you for the next hour, so stay tuned for more.
Happy Friday. Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. On today's show, it's all about the consumer wallet here. We ask an expert about spending trends that we're monitoring, plus housing hurdles. Mortgage rates may have declined over the past week, but the majority of Americans think it's still a bad time to buy. We'll bring you the pulse of the home buyer. Plus, work burnout. That could be costing you thousands of dollars. We bring you the tips and tricks to avoid becoming discouraged at the office, and if you're managing a workforce, how to avoid losing some of that top talent. Well, let's kick it off with a look at the consumer here. Bank of America's latest consumer checkpoint shows total card spending per household in April rose 1% from the year prior, a big rise from 0.3% in March. The bank attributing the gain to an early Easter, seasonal factors, and tax refunds. For more on this, we turn to David Tinsley, who is the Bank of America Institute senior economist here. David, great to have you on the program with us. First and foremost, just walk us through the top takeaway here and what you're seeing in card spending per household and what's really the catalyst there.
Thanks for having me on, Brad. Yeah, I mean, I think our mantra at the Institute for a while now has been that the consumer spending momentum is soft but stable. And when we look at our 69 million customers and sort of past their credit and debit card spending, we get the numbers you referred to there. So spending in April up about 1% year on year, actually looking a little bit better than March. But the truth be told, the data's been pretty choppy over the last few months due to calendar effects, Easter, leap year, etc. Looking through that, I think the story is continued spending momentum, not particularly accelerating or decelerating to any great extent. And I think within that story, and this is really interesting because there's been a lot of kind of corporate and market chatter around the low-end consumer. What we're seeing in our data is that the low-income consumer is still spending. In fact, their spending growth is faster than the higher income consumer. So that's a pretty good news story, I think.
Why do you think that is? Take us further into that data point, because I was looking at some of the charts here, one of the exhibits showing that lower income card spending growth stronger than that of both middle and higher income consumers as of April, as you were just mentioning. What's really driving that?
Well, I think first and foremost, it's a labour market story. The consumer always comes back to the labour market. And when we look at our data at the lower end of the income distribution, wages and salaries, which we can see by the money going into people's bank accounts, if you like, is up 4% year on year. And at the higher end, there has been some acceleration, actually, but growth there's around 1%. So what's going on there? Well, the labour market has been very beneficial to the lower end over the last few years. You kind of had that reopening story after the pandemic, lots of jobs in leisure and hospitality, also in healthcare. Still, there's momentum there. Obviously, we have to watch the data really carefully from here to see whether that slightly softer payrolls report last week, whether that keeps going in terms of, developing in the data. But near term, the outlook is pretty solid, I think, for the low end. And just one other thing I think is worth noting, that when you look at the savings, the cash in people's bank accounts relative to pre-pandemic times is still well up. So, and that's true across all income cohorts. Right now, due to the tax refund season, it's up about 70% almost at the lower income end of the distribution. So, that gives a little bit of wind in the sails for consumers receiving those refunds too.
Yeah, and it's interesting because there's one thing to have the savings that you use that refund to build up. It's another thing as well to really reduce debt and look at it as a mechanism to cut into where you owe, and lower income consumers using those tax refunds to reduce that. Another core point within this report, I wonder where else you're seeing spending driven by some of the tax refunds right now.
Yeah, so when we look at the tax refunds going into accounts, we look at the period just before, the 3 weeks before and the 3 weeks after, we can kind of track the boost to spending. And you do see the spending increasing in clothing and consumer durables, actually, which is pretty interesting because usually speaking, the consumer story is around this pivot to services over the last year or so. Services did increase as well. There was some spending there. And then, as I was saying, the deposits rose somewhat. So in other words, people, at least for now, have banked some of the cash. And as you were saying there, what's interesting, and perhaps a note of caution, is that the lower end of the income distribution, the lower income consumers, they paid some debt down, more so than the middle and the higher end. So in other words, they paid debt down. What debt? Student debt, it seems, and credit card debt. So, sensible, prudent actions, but perhaps also a little sign of caution on the part of the lower income consumer as well.
It's interesting. Caution seems like it's going to be a word that contributes to some of the moderation we might see in spending. And I think back to the data that just came out this morning from the University of Michigan and the Consumer Sentiment Index showing that consumers had been reserving judgment for the past few months, but now they perceive negative developments on a number of dimensions, whether that be inflation, unemployment, interest rates, potentially all moving in an unfavorable direction in the year ahead. I wonder how you're evaluating that as well and what type of moderation you would expect as a result.
That's an interesting point. So consumers, despite the economy in pretty good shape, really, and the labour market's in good shape, we're seeing the spending growth, they've been pretty pessimistic for quite a long period of time. And I think first and foremost, that's been an inflation story. So, even now, although price inflation, although the rate of inflation has come down, you go and buy a coffee or something like that, the price is well up from where it was pre-pandemic. And I think that still weighs on confidence. And I guess people have seen the inflation rate come down, but they're still seeing those price increases. And the other thing, I guess, that's going on right now is, the Fed's situation. The narrative around the Fed has changed from near-term cuts to higher for longer, maybe a cut at the end of this year, perhaps, as a B of A global researcher forecasting. So I guess the consumer is also perhaps a little bit hesitant, a little bit downbeat on that outlook as well. So there certainly are things weighing on sentiment there.
It's really hard to keep the midpoint of my coffee purchases, David, at about $3.25 at this point right now. Sometimes I splurge and I go to the $7 coffee manufacturer out there.
Right.
We all know them well. But at the end of the day, a lot of decisions, micro decisions that add up to macro results, hopefully, for consumers. David Tinsley, thanks so much for taking the time here this morning.
Thanks so much.
Absolutely.
Thank you.
Great to see you. Bank of America Institute senior economist David Tinsley there. Moving things right along here. Coming up, Americans not too happy with the state of the housing market. We're going to tell you why on the other side of this short break. Let's do a quick check of the market, sponsored by Tasty Trade here. Taking a look at the Dow Jones Industrial Average right now, that's holding on to gains of about 0.2%. S&P 500 flat just barely to the upside here. In the Nasdaq Composite, you're seeing that in the red right now. That's down by about 0.2%. Ever invested in something just because you see a craze or a fad? Think investing in Peloton, fueling its meteoric rise when everyone was cycling in their homes amidst the COVID pandemic back in 2020 and going nowhere. But with Peloton down over 97% since its record highs, you might want to learn how to distinguish between a fad and a trend. To break it down for us, we've got Yahoo Finance's very own Julie Hyman here on the case. Hey, Julie.
Hey, Brad, I wish I could tell you easily how to do it. I mean, really, the only thing that can truly tell you if it is time. But I can give you a few examples. And the thing that sparked this in my brain was Roblox, the company coming out with earnings this week. For those not familiar with Roblox, it is a video game platform. People can build games on it. People can play games on it. There are tens of millions of games on it, and a heck of a lot of people on it, including my children. So this is, if you think about Warren Buffett, who has said frequently and famously, invest in what you know, Roblox is something that I am quite familiar with in my own household. But the stock, as you can see, fell quite sharply this week after the company came out with a bookings forecast that disappointed investors. And, this is one of those companies where you wonder about its staying power. If you go back and look at how the stock has done since it came public a few years ago, you have seen that it has declined sharply. So I've been thinking a lot about this sort of definition of a fad, if you will. And this is a fad from a consumer perspective, right? A practice or interest followed for a time with exaggerated zeal. So it's something that everybody is seemingly everywhere all at once, very popular, but then a fad tends to fade, right? So the other sort of poster child or example that has really been in the news lately is Peloton, right? And Peloton's sort of faddishness, perhaps, is evident if you look at its sales trajectory. Of course, back in 2021, when everybody was home, is when it saw its high in sales of around $4 billion. And since then, it has trended lower, as especially the hardware, the bikes themselves, the cycles, we have seen a fall off. And the company has tried to sort of replace that by the subscription growth of the platform, for example. So that's been an interesting trajectory. Peloton's stock chart looks a lot uglier than that of Roblox. As you see it here, it's down 95% over the past 3 years, down 97% since its highs that it reached back in 2020. Beyond Meat is another example here. Now, plant-based meat, you could argue, is here to stay, but if you go to your grocery store, you definitely see a lot of different varieties in your freezer, not just a Beyond Meat. So we've seen a collapse in that stock. On the other hand, there are some other things that maybe people thought were fads that ended up having staying power. And I think of Uber in particular here. If you max out this chart, right, you've actually seen it go higher. And there were some real questions about whether Uber was going to be a sustainable business in the beginning, both because of some things going on with the business itself. They were tracking people after they got out of the cars, but just regulatory hurdles, et cetera. Airbnb is another one I think of that when it first came out, people said, I'm going to rent out a room in my house to strangers, and yet obviously that's had some staying power. Although that stock is down from its early highs, it has had definitely more recent outperformance. So that's sort of how I've been thinking about it. And, there are examples of each, but again, it is sort of a time game, Brad, where you just have to kind of see if it ends up staying around.
Yeah, so let's talk about investing fads versus consumer fads and where the case studies have kind of netted out for each there.
Yeah, I mean, some of them are both, right? In the case of something like a Peloton, obviously the stock followed the enthusiasm for the product itself. But I think you do have to differentiate between investing fads and consumer fads. The ones I've been talking about are more on the consumer fad side. When you're talking about investing fads, I think you can say meme stocks are one example. Here's our heat map of the meme stocks, right? And there was the meme stock craze that was more about the stocks themselves than necessarily the underlying products and the popularity of them. GameStop, for example, AMC are a couple I think of. It's not that everybody was all of a sudden going to movie theaters or going into a GameStop, but it's that people wanted to invest in these types of stocks. You might think of Bitcoin as another type of investing fad, although maybe that one has a little more staying power because people have come back to it as it has seen different cycles. So just to sort of categorize them in your mind and think about sort of consider that when you're figuring out whether to chase something or not.
Julie Hyman herself, no fad, always on trend.
Oh, well,
Julie, appreciate it. Thanks so much. Well, mortgage rates falling for the first time since mid-March this week. This marking the first decrease after 5 straight weeks, pushing the borrowing costs well above 7%. So to break down what this means for potential home buyers and owners, we've got Yahoo Finance reporter Rebecca Chen. Hey, Rebecca.
Hey, Brad. So we did see that mortgage rate for a 30-year average fixed rate drop to 7.09 this week. And, this was a welcoming drop, as you said, after 5 weeks of rising. But I did want to point out that mortgage rates are still pretty high for home buyers in today's environment. It is still over 7%. So if for a new home buyer who are interested in looking for a home to purchase, they are facing a financing cost that has more than doubled over the last 3 years, when rates was about 3% in 2021. So this obviously is a point of sort of struggle for many people who are trying to find that affordability.
And Rebecca, a new Gallup poll finds 76% of people who are in this market here and Americans say it's a bad time to buy a home. So can you tell us more about the sentiment around home buying?
Absolutely. So we actually been seeing a similar number across different survey. Another survey that came out this week, very similar to this one, also said that 80% Americans are not feeling like it's a good time to purchase a home. Now, this came from Fannie Mae, the mortgage lender. What we really saw was that because of the high interest rate, in an environment where home prices are also very high, buyers just don't feel like now is a good time, and many of them are taking that wait and see approach. And this is pretty significant because if you really think about it, let's say you ask 5 strangers on the street, 4 of them is going to tell you that now is not a good time to purchase a home. So it's quite obvious to us that right now Americans are not feeling very confident in this home buying arena. And another thing I wanted to highlight from the survey is that this kind of pessimism or lack of confidence in home buying has been sort of consistent. And the reason why we think it's consistent, and based on talking to a couple experts in the industry, say that because we're so unsure of what's going to happen next with mortgage rates. Obviously, we are thinking, many home buyers are thinking that, the Fed could cut interest rate next, and they themselves have said so. But the indications are just not showing when or how much this is going to happen. So this uncertainty have definitely caused a lot of lack of confidence in home buyers in the U.S. today.
Rebecca Chen, thanks so much for continuing to track everything around the home buying market and breaking this down for us. Appreciate it. Well, are Americans doing a good job managing their savings? That's the big question. And according to a new survey from Santander Bank, the answer is somewhat mixed, with only about 20% of Americans saying they have more than $25,000 in their savings. To help break down this survey, as well as giving us more tips on how to save, we've got Tim Wennis, who is the Santander U.S. CEO. Thanks so much for taking the time here with us, Tim. We'll get to the tips here in a hot second. We just got to dive into these findings, though, and really kind of get a sense of where you're seeing this from the Santander side as well.
Brett, thank you for having me on. I'd say the positive takeaway from our survey is the majority of Americans were building savings, adding to their savings in the first quarter. This is against a narrative where we're hearing that people are spending down excess savings coming out of the pandemic. So that was a positive finding. And I think showing that 3/4 of individuals do have savings goals, and the majority are meeting those savings goals. So I take that as a positive. On the flip side, we're finding that people are not necessarily doing all the planning that they need, and that many people don't have good awareness. They don't have financial confidence in terms of their knowledge, and aren't taking the actions necessary to achieve those savings goals, or paying attention to what interest rate they're earning on that money they've worked so hard for.
How has the confidence kind of moderated of people, of savers, to continue adding to an account where they're building up the nest egg?
What's interesting, some other research that we do, we're finding that 3 in 4 Americans are they're optimistic that they're on the path to financial prosperity. And the big obstacles to that have been inflation for the past year, and some of those are starting to come down. But what we're still seeing is far too many people are not taking action. And only 1 in 5 have taken the opportunity to move to a higher rate savings account or certificate of deposit in the past 12 months. And still 60% of savers are earning less than 3% on their savings. And with market rates in the 4 to 5% range, they're leaving real money on the table.
What is the benchmark figure right now on average that you're seeing people move over to a savings account on a monthly basis, perhaps?
Well, we've got the majority of Americans are kind of in that middle tier. Federal Reserve data says about $8,000 is the median savings account. And if you think that we've got the majority of people earning less than 3%, market rates would be closer to 5%. They're leaving as much as $20 a month on the table in terms of foregone interest.
Wow. Okay, so let's get to some actionable tips here for people who are trying to turn the tide or kind of turn the corner here in their own savings habits. I was taking a look at some of your own GPS tracker data as well here and the report that was the impetus for this conversation. Where are you seeing people employ the necessary kind of tricks in order to just change the mindset around savings?
So the first thing is assess where you're at. How much do you have in savings? What interest rate are you earning? And what are some of the other options? For some people, if you haven't started savings or you're not accumulating as much savings as you would like, make sure you're setting the appropriate goals and make it easy for yourself to save. Pay yourself first. Set up that automated transfer into your savings account right when your paycheck comes in to help you start to accumulate those savings. The majority of Americans have a savings goal of less than $300 a month. So it doesn't matter how much you start with. What matters the most is you start now and that you're doing it on a consistent and regular basis.
Tim, great to see you. Thanks so much for taking the time and breaking down some of the findings here from Santander. Tim Wenis, who is the Santander U.S. CEO. Appreciate it.
Brett, thank you so much. Have a great day.
Certainly. You too. Coming up, everyone, the connection between health and wealth. We're talking about how a stressed mindset could impact your financial goals. That's next. Nonprofit healthcare network Ascension, which operates 140 hospitals in 19 states and the District of Columbia, was hit with a cyber attack earlier this week. As the result, the healthcare provider has confirmed a number of disruptions to services. Here with more and tracking this throughout the week, we have Yahoo Finance's Anjali Khemlani. Anjali, you gave us an update on this. Once the news broke, what's the latest on it?
Yeah, so after the initial attack was found on May 8th, we did get the update that the company was looking into just how widespread this issue was. They did have service interruptions at the time, and they're still investigating whether or not these attacks had any impact on personal health information. We do know that it has disrupted access to that, including MyChart, which is one of the largest in the country, as well as delayed surgeries, appointments, and postponed appointments, in addition to having to divert ambulances until they could get back online. And that is not very different from what other health systems have had to deal with and contend with whenever they are attacked.
And Anjali, this was one of many cyber attacks on healthcare networks in the last year. Generally speaking, tell us about the system that these providers operate under and how everyday Americans could be affected when something like this happens.
Yeah, so they're legally required to, and by regulatory law, are required to notify patients if their health records are impacted. And that's the very important part that they said they would once they find out. Now, the way that these health systems operate, we saw a little bit of this with the United Health Change healthcare attack, with how widespread of a problem it can be. Most of these hospital systems, differently from United Health, operate within sort of the insular bubble of themselves with the addition of third-party technology platforms. And that includes the likes of Oracle, Microsoft, as well as Epic, that largest private holder of electronic health records. And so these entities are on the back end of the operations, and that is the system that they operate under. So they really aren't necessarily on their own responsible for some of this. They really do have other parties to contend with and other players in the whole process that they have to work with in order to find any of this information.
Yeah, healthcare has repeatedly been called one of the most vulnerable sectors, the most vulnerable sector in cybersecurity as well.
You're talking about an industry that still uses a fax machine, so.
My goodness, they still make those,
They still make those.
Jeez. All right, we need to stop that. Anjali, thanks so much. Appreciate it. Anjali Khemlani joining us there for that. Plus, everyone, and this is why we have a topic like this for Health is Wealth Week. Listen up, employers out there. It may be time to reevaluate your workplace strategies, especially when it comes to mental health. Employees are feeling the burnout. A key report from AFLAC found that an overwhelming 89% of workers feel high levels of stress from their jobs. For more on employee burnout and the financial challenges it leaves on employers and employees, I'm joined by Jerry Hawthorne, who is the AFLAC Chief Human Resources Officer. Great to have you here with us, Jerry. And first, let's start off by breaking down some of the findings and what you've seen more broadly here among the employee-employer relationship, especially related to burnout.
Yeah, thanks so much for the opportunity, Brad. And it's a startling statistic that 89% are feeling burned out. And it aligns both with our internal population as well as what I think most organizations are facing. And burnout has direct impact on employer productivity. It has direct impact on employer success, on business success. So employees that are less engaged in work, that are feeling less supported, less well overall, they're less likely to exercise high levels of discretionary effort, which means that when they're engaging with customers, it may not be at the level that employers want. And it means the customer service could go down. So it's really important for employers to take a hard look at how they're supporting employees and how the types of programs they're offering around wellness, not just physical wellness, but mental and emotional wellness overall.
What is the leading driver of feeling burnt out or feeling stressed at work from what you've found in so much of your research looking across things?
Yeah, I mean, I would tell you that one of the things that we found was that more than half of the people that we surveyed said, from the AFLAC Workforces report, said that they couldn't go 1 month without a paycheck. right? So when you look at inflation, when you look at the continuing rise of the price of services and goods, and you have people who can't go 1 month without a paycheck, that says to me that financial impacts and financial wellness are probably one of the biggest drivers of anxiety and concern for employees. In fact, our workforce's reports found that more than half of the people we surveyed said, I can't go, I don't have $1,000 for an unexpected out-of-pocket medical expense, right? So if you can't pay for those unexpected expenses, that creates anxiety. That anxiety leads to other issues from a health and wellness perspective. It increases absenteeism, it increases performance, it increases toxicity in the workplace. All of these factors impact overall wellness. It almost creates a cycle of negative reinforcement around how people are feeling and around the impact that it has on organizational health.
You know, it's interesting, and especially when you have so many generations. I don't know if this is a point where we've had the most crossover in generations that are actually supporting the workforce, but it certainly feels that way, at least. And from some of the more seasoned generations, or those who have a lot of workplace history, they might say, I'm not trying to call anybody old, but they might say, hey, just toughen up. Whereas other younger elements of the workforce might say, hey, there are actually ways we can be more efficient if you listen to the things that we're suggesting here. So where are you seeing kind of that push and pull between generations even, and how work is approached to create more balance?
Yeah, and that's interesting. So I think that every generation has that. So I can remember when I first entered the workforce, and we were considered very radical on a relative basis to employees that had been with the organization a very long time. So I think that tends to be cyclical. But, if you look at newer employees to the workforce, they're typically lower paid employees. And so, our workforce report found that 68% of Gen Z and 64% of millennials say that they're facing high levels of burnout, which is about 10 to 15% more than your Gen Xers and longer tenured employees. And so there does tend to be the push and pull between, hey, do it this way, leverage technology, and you have employees who've been there a long time saying, you know what, we've always done it this way, it's very effective. And I think it's really incumbent upon managers to balance that, because both are correct, meaning that processes and the way organizations go about things exist for a variety of very specific reasons. But organizations that don't capitalize on trying to leverage new ideas, on trying to become more innovative, to become more efficient, those are organizations that end up getting left behind in the overall evolution of the business world. So it's very important for managers to take a look at both and say, how do we actually integrate both of these ways of working and get the best for our customers and make our employees feel valued and heard?
Jerry, there's much more to this conversation. Would love to have you back on to continue. We haven't even gotten to the 4-day work week.
Nope.
Would love to hear your thoughts on that in the future. Jerry Hawthorne, Aflac Chief Human Resources Officer. Thanks so much.
Thanks so much, Brad. Have a great day.
You too.
Bye.
A new Bankrate survey finds nearly half of U.S. adults say that money has a negative impact on their mental health. This includes effects such as anxiety, stress, worrisome thoughts, loss of sleep, or depression. And the same data reveals women are worse off, with 51% reporting the negative effects versus 42% of men. Here with more, we've got Yahoo Finance's Carrie Hannon and Maddie Dichtwald, who is a financial expert and author of the book, Ageless Aging. There you see the cover of her book. Thank you so much for taking the time here with us, Maddie. First and foremost, going into some of the findings and then ultimately trying to figure out how, and this kind of dovetails into our previous conversation as well about burnout and where there's stress and elevated stress, particularly among women in the workforce right now. Where are we seeing some of those tides shifting and the additional work that still needs to be done?
Yeah, well, thank you for having me, Brad and Carrie. It's great to be here with both of you. And yeah, there is a lot of stress out there, and that stress oftentimes comes from our financial well-being. I mean, if we don't have our finances in good shape, then chances are that our stress levels go up. And if our stress levels go up, it can create inflammation in our bodies, which manifests in a variety of different diseases, from diabetes and even heart disease to just having aches and pains and just not feeling very well. And it's even worse for women than it is for men, as your statistics just showed. We know that women, in many ways, have lots of great advantages in terms of we live longer than men. I mean, we've actually won the longevity lottery, living an average of 6 years, longer than men. However, when it comes to our health and well-being, we're not doing as well as men. The average woman spends 12 to 14 years in a cascade of health problems. And these health problems oftentimes emanate from stress. And that stress is, as I said earlier, oftentimes comes from finances.
So Maddie, what can women do? I know you've done a lot of research with women and money. What can they do right now to take control of their financial lives to make aging better?
Yeah, the first thing that we all women need to do is we need to realize that we need to plan for the 100-year life. I mean, thinking that you're just going to live to 75 or 80 or 85, it's really not good enough. We need to plan to live to 100. Second, I think we need to make sure that our financial knowledge, is really up to par. There are so many resources available. Carrie, you provide so many of them that we all ought to take advantage of them. And third, we need to build our financial confidence. It's really important. Knowledge creates confidence. And then if we have that confidence, we're more likely to invest. One of the things that we learned from some of our studies at AgeWave is that women, their biggest financial regret is not investing more. And the main reason they don't invest more is because they lack financial confidence.
And they also would rather talk about their debt than their money, right?
Yeah, oh yeah, for sure. They're very comfortable talking about debt. One of the other things that we've learned from studies at AgeWave is that there's this kind of taboo for women against talking about money. Now, sure, we'll talk about, like you said, debt. We'll also be willing to say how much our shirt cost or our handbag or something. But when it comes to talking about how much money we make or how much money we save and invest, we don't really talk about it. So we've got to break that taboo.
Go ahead. Sorry, Brad.
Sorry, no. Carrie, go ahead, please.
No, I was just going to ask, in terms of just quickly about working, that I'm a big work person. So how can work help us age better?
It's a great question to be asking. Work, believe it or not, is one of those elements in our lives that can actually add a great sense of purpose. And having a sense of purpose, believe it or not, according to science, it can actually add years to our life. But let's take it even a step further, because this is a really important point. One of the key things that we're hearing more and more about is this whole idea of social connections, and how social connections are one of the keys to living longer and living healthier. So it can increase our health span and our lifespan. So one of the studies that we've done at AgeWave, we asked people what they were going to miss most about the workforce. And we asked people who were in the workforce, pre-retirees, and we asked retirees. Pre-retirees said, we're going to miss the money. And yeah, you think about it, that makes perfect sense. But then we asked retirees, and they said the number one thing they missed were the social connections. So work provides not only a sense of purpose, but a sense of community, a sense of social connection. And by the way, that really does help lower our stress.
Maddie, thank you so much for the time, the tips here as well. Maddie Dickwald, who is the author of the book Ageless Aging. There you see the cover. Thank you so much. And my thanks as well to Carrie Hannon joining us for the conversation.
Thank you both. Appreciate it.
Thanks. According to the CDC, as of 2022, the life expectancy of Americans was 77.5 years. That's up about 4 years since 1980. So with Americans living longer, what are some steps to financially plan for a longer life? Yahoo Finance contributor Ross Mack has more.
All right, guys, it's your boy Ross Mack of Macconomics. And look, as life expectancies rise, so does the importance of planning out our finances for an extended future. Look, longer lifespans means that retirement funds need to last us a lot longer than they did before. Therefore, guys, we have to shift how we approach our savings and investing. So here are a few things to consider and some actionable steps to take to ensure that our retirement funds never ever run out. First things first, I want you to actually reevaluate your retirement age. For instance, right, the life expectancy for a healthy female is roughly about 80 years old. So you need to ask yourself, do you have enough money saved for retirement that will actually last you till you get to 80? Another thing, right, what are your annual expenses? Using the FIRE rule, which stands for Financial Independence Retire Early, you want to have roughly 25 times your annual expenses saved for retirement in order to feel comfortable. Now look, third, I want you to diversify your portfolio. You want to have a mix of safer assets and higher yielding assets that balances the risk and the returns that you want. Now look, guys, it's important to note that as you get older, you want to shift your investment mix to safer investments. Look, guys, as you get older, that risk tolerance is going to go down just because you don't want to have those volatile returns in your portfolio. Fourth, I want you to take advantage of your retirement accounts, right? Try your hardest to max out those contributions in your 401k and your Roth IRAs. Now, the biggest tip I always recommend is make sure that you're maxing out your employer contributions. And fifth and lastly, another thing to consider is that we're living longer. Guess what? We're also going to mean that we're going to have higher medical costs. So therefore, I want you to consider investing in an HSA account, health savings account, which offers you tax advantage ways to cover your medical expenses when it comes to retirement. Hopefully that helps you guys prepare for a longer life.
A new readout on the pulse of the consumer. National Retail Federation reporting retail sales grew modestly in April, with the total sales, including automobiles and gasoline, up nearly 0.3% from March. For more on this, I'm joined by Catherine Cullen, who is the National Retail Federation Vice President of Industry and Consumer Insights. Catherine, great to have you here with us on the show. First and foremost, I read through this report. I looked through some of the line items as well here. Just want to get the broad read right now on what we should be making on the pulse of the consumer.
Well, thanks for having me on, Brad. And what we're really seeing is something we were expecting this whole time, which is a normalization of consumer spending. We're seeing shoppers across income spectrums facing various challenges, shifts in their spending patterns. They're really prioritizing what's important to them. And as we expected, we're seeing a moderated level of spending on goods, though still above what we saw last year, and we're still on track to achieve between 2.5% and 3.5% growth year over year for the entire year.
All right, so as we get towards normalization, what does that mean for the category level? What performs best during normalization and what underperforms?
Well, we know that today's shopper is facing high inflation in some aspects of their life, like services. So they're rebalancing their budget on some goods. They are looking really for value. For some consumers, that means maybe shopping a little bit more discount, maybe trading down to a private label brand, maybe pulling back on dining out, which is a category that we saw performed a little less strongly this past month, in order to spend on some of the other areas of their lives. But we are seeing that consumers are expecting their wages will keep up with inflation. They are expecting to continue spending. And we're even seeing that with some strength in categories like sporting goods, heading into some of the warmer months of the year, as well as home and gardening sectors, as again, we're heading into kind of spring, summertime with people sprucing up their lawns and spending more time outdoors.
Yeah, big green thumb energy there for sure. You know, Catherine, as I think about how the way that the consumer has been defined has shifted over this past 18 months from resilient to healthy, and to now, it seems like the consumer, as we're defining more broadly scale, because it is tiered between high income, middle, and then low income, it seems like on aggregate, we're saying that the consumer is normalizing. Or where is the true definition of that? What is the one word?
I like to use savvy. This is a shopper who is used to balancing their budget, and they're reacting to forces that they're seeing in other parts of their lives. If they see higher prices in one area like gas or travel or health, they're being smart with their money, saying, hey, I'm going to rebalance my budget, look for sales, look for promotions, make sure I can really afford the items that my family needs. But we are really seeing consumers invest in what's important to them, obviously getting through on essentials, but also we're seeing strong spending around holidays and special events. And we are continuing to see spending around experiences. So this is a consumer that still feels comfortable, still feels somewhat confident in their own job security, and feels a level of comfortability continuing to spend. Certainly things can change. We know, obviously, not to get too used to normal these days, but we are seeing this consumer be very savvy, very smart with their money.
All right, I like to be called savvy, so I'll take that. Catherine, thanks so much. Catherine Cullen, who is the NRF Vice President and Industry of Consumer Insights. Great to speak with you here today.
Great to speak with you as well. Take care.
Thanks. Well, we're wrapping up Small Business Week here on Yahoo Finance as well. And what tech are small businesses using to push them to the next level? Big question. We break that down for you on the other side of the short break. 95% of small businesses use at least one form of a tech platform, and 87% report increased efficiency thanks to tech. According to American Innovators, that data comes in. As part of Yahoo Finance's Small Business Big Opportunities Week, we're exploring how tech can help empower small businesses. For more on this, we've got Yahoo Finance reporter Dan Halley here with more. Hey, Dan.
Yeah, that's right, Brad. Obviously, when it comes to efficiencies, tech is the only way to go. And so there's a few things that small businesses can look for as far as technology goes that can kind of help them step their games up. Number one, obviously, when it comes to advertising, you want to get your business out there. Social media is absolutely huge. If you look at something like a Meta or Instagram, also underneath Meta, Facebook, Google, YouTube, these are all social media companies that are going to allow you to hit a niche market rather than just spreading your image or your message across a large area. So you can finely tune who you want to target advertising with through these companies, and that'll ensure that you'll get more bang for your buck, really. We saw how that actually impacts businesses when Apple turned off Facebook's ability to get access to user data. The Facebook sales started to fall because they weren't offering that exacting data. So it's just proof that these kinds of companies, social media companies, are a good vehicle for marketing for small businesses. The other thing is AI. I know we talk a whole bunch about AI because of generative AI, but there are AI features that companies can help, such as automated accounting that can allow them to kind of clean up their processes. And then finally, we have cybersecurity. Very important. A lot of companies can't afford to take hits when it comes to cybersecurity. They'll lose a ton of business.
Dan, thanks so much for breaking this down for us and some of the important areas that small businesses are investing in major technology to help them and their business. We are wrapping up our Small Business Big Opportunities Week. We explored the different headwinds that small businesses face, like inflation and high interest rates, and we spoke to business owners on what difficulties they're facing. Take a listen.
Supply chain is still disrupted. Inflation is still giving us a lot of pain. Inflation especially has hurt us a lot. The cost of packaging, glass, honey, sugar, all our ingredients is up more than 50%. Gas is up, and that's hurting us. We have full health insurance and benefits for our employees. That's gone up a lot. Finding people is still not easy.
We've seen a decline in the last year in sales online and at our brick and mortar store. And we've also seen the struggle of finding great team members, of being able to compete with wages and benefits and pay them well. And we have just really struggled to engage with our customers again without throwing lots of money at ad dollars.
And nearly half of small businesses fail in the first 5 years. That's according to the Small Business Administration. But small business owners have learned lessons on how to beat the odds along the way.
Just to be prepared for those mistakes. I think that's really the key to really starting a successful business is it goes really, I would tell myself it's going to go beyond so much more than just your idea and your passion. It's going to take putting your ego to the side.
And there are resources to help them thrive. We spoke to the Small Business Administrator, Isabel Casillas Guzman, about what supports the federal government offers small businesses as well.
My biggest advice to small businesses, especially coming from the SBA's perspective, is you got to know what you know and know what you don't know, and get the assistance that you can get out there that's available through the federal government. And, so oftentimes small businesses, when they start up, have to wear all these multiple hats. They don't have the resources to immediately hire up across the key verticals. And so for small business owners, coming into the free networks and resources at the SBA helps you power up those skill sets. And so I would really highly recommend that small businesses get the assistance, build that team of free advisors that the SBA provides.
And so, with nearly half of Americans working in a small business, accounting for over 99% of U.S. businesses, according to the Small Business Administration, the sector's resilience is crucial for the broader U.S. economy. You've been watching Wealth here on Yahoo Finance. I'm Brad Smith. We'll see you next week, and you can stay tuned for Market Domination later today with Julie Hyman and Josh Lipton. That's coming up 3 p.m. Eastern. You don't want to miss it.